parts of the market that could be allegedly overvalued, but this is backed up by a strong economy, good earnings, good consumption.
The quality factor and the momentum factor, frankly, have been just dominant in the U.S. equity market.
The earnings outlook from at least a market-weighted perspective is still supportive of those risk assets.
Business and the consumer are doing what they should be doing. They're showing up.
People are simply doubling down on existing bets because they think this party's going to keep going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. That feels good, doesn't it? I mean, for some of you at least. Like from New York City this morning, I could see Manus and Danny are furious because they're doing the program on Friday.
Literally everybody who's going to be working on Friday.
I apologise.
Speaking your book.
I apologise. Let's start the show again. From New York City this morning. Good morning for our audience worldwide. Equities at all-time highs on the S&P 500 coming into Wednesday. The day is short, but the day is absolutely stacked. Let's deal with the short part first. So equities closing at 1 p.m. Eastern time. The bond market closing at 2 p.m. Eastern. Let's deal with the stacked part. We'll go through the data first. ADP, jobless claims, ISM Services Index, the Fed speak, Fed minutes at 2 p.m. Eastern time. I think we get John Williams of the New York Fed in the next hour or so from Sintra, Portugal. Lisa, that day is stacked.
And to me, what I'm watching actually is ISM Services first and foremost. And then after that, the jobless claims, given the fact that we've seen this slow grind upward in terms of the numbers of people who are out of work looking to get some benefits. To me, the idea of ISM Services, if it has the same kind of downside surprise that manufacturing did, that is going to move the needle in a more significant way.
Did you think Chairman Powell was dovish yesterday?
Yes, I did.
Let's go through the quote. Showing signs of resuming the disinflationary trend. That's an additional quote from the chairman since the last meeting.
Okay. He said significant progress, real progress, and quite a bit of progress. All of that within some of his rhetoric yesterday. He did say we want to be more confident that inflation is moving sustainably down. He wouldn't talk about a date when people pressed him on September, and yet clearly you saw the market price in a greater chance of a September rate cut because of this sustainable progress, real progress, substantial progress type of language that we really heard from Jay Powell for the first time.
That's Powell. Let's do the politics. We're going to spend a lot of time on this throughout this morning. The polls, the officials opening up, the leaks, the excuse. There is a new excuse coming from Mr. Biden, the president. This is it. I wasn't very smart. I decided to travel around the world a couple of times, came back and nearly fell asleep on stage. I mean, that in and of itself sounds absolutely terrible, but let's go through the timeline. You're back from Italy on June 15th. Debate was 12 days later. And never mind the fact that you were at Camp David for about a week to really prepare for all of this and do basically nothing else.
These excuses are landing flat, to be very generous. The point is, even if that is the excuse, it doesn't get away from the basic fact that he is an older man who seems to be needing more rest and needing more time to really recuperate in a job that requires a very demanding schedule for even a young person. You look at pictures of presidents when they come in and presidents when they come out and they're great, et cetera. There is a chorus that is undeniable from the Democratic Party saying to Joe Biden, it is your time, step aside. And it is public, and the leaks are coming fast and furious, and the polls are suggesting that his chances of winning are plummeting.
Yesterday, it felt like the dam was beginning to break. I saw that line repeatedly throughout the news yesterday. And to hear the former House Speaker, Nancy Pelosi, add on American TV saying, I think it's a legitimate question to say, is this an episode or is this a condition? Is it an episode or a condition?
The fact that people are saying the quiet part out loud tells you where we are. If you just look at the polls, PredictIt, for example, the betting marketplace says that Joe Biden now has only a 40% chance of being the Democratic nominee. This is a time when he is quickly losing clout in terms of his ability to actually run. When you take a look at YouGov poll, 60% think Trump won the debate. 61% of Democrats want the Democratic Party to choose someone other than Biden as their nominee. You see the dam is breaking. The chorus is mounting. Either way, the pressure is undeniable. Will the Biden camp respond?
Got two more polls for you, Lisa. CNN, 3/4 of voters say the Democratic Party would have a better shot without Biden. This was from Reuters. 1/3 of Democrats think Biden should end his re-election bid. You just see it repeatedly.
The problem is, and when you take a look at some of what has been gamed out, it's all really premature. Who has a better chance of winning against Donald Trump? That is one question, especially at a time where Kamala Harris can have the financial war chest that Joe Biden does. And then there's this question of some of the recent Supreme Court rulings, particularly with respect to immunity, and how much that also amps up some of the pressure, how much that sort of raises the temperature of the Democratic Party, given some of the doom case scenarios that people are putting out there.
Much more on that story a little bit later. Nothing doom and gloom about this market right now. All-time all-time highs on the S&P, on the Nasdaq 100 coming into Wednesday. Equity futures just a little bit positive on the S&P, not doing much. In the bond market, yields lower by a single basis point. The 10-year 442.17. Coming up this hour, we'll catch up with James Athey of Marlborough Investment Management on why it's too early for the Trump trade. Isaac Boltansky of BTIG as Biden blames travel for the debate debacle, and Citi's Andrew Hollenhorst calling for a recession in the second half of this year. We begin with our top story, investors positioning for a potential second Trump term. James Athey of Marlborough Investment Management writing this: isn't it a bit keen to be positioning for the Trump trade 4 months before the election, 6 months before inauguration, and based on the 2017 timeline, around 18 months before the passing of legislation? James joins us now for more. So, James, you think maybe this move is a little bit premature?
Yeah, either that, John, or really we're sort of backward engineering a narrative to describe the move higher in Treasury yields. I mean, the timing with respect to this move higher in the odds of Trump being elected doesn't seem to tie up perfectly. It almost looked to me like maybe there was a bit of inventory overhang from dealers into and out of month end, and that's just precipitated a move higher in Treasury yields led by the long end, and now we're starting to sort of engineer that into being related to an increased chance of Trump's election. So either way, for me, now is not the time to push hard on trades, investment ideas which rely on Trump passing legislation. I think there's a lot of wood to chop before we get there.
So, James, what should we rely on? You say it's too early to position for a Trump presidency. You say there's nothing clear on the macro front either. So what should I focus on and what should I do?
No, exactly. And that's the difficult thing. I mean, the trend in the last 6 weeks or so has been a reversal of the trend which had preceded it, which is to say we've had some upside surprises in economic data in Europe and the UK and some downside surprises in the US. But broadly speaking, the US still feels like it's in a better place. You know, if you look traditionally at economic cycles, they don't turn on the consumer, they turn on business investment, and that then precipitates through into higher unemployment in the consumer. In Europe and the UK, we are seeing that deterioration in investment data. In the US, actually, we've seen that picking up of late. And so it still looks to us that you should be more comfortable taking duration positions from an economic perspective in Europe and the UK. We've already had one cut from the ECB. Yes, they got buyer's remorse, but I think the data is going to give them cover to continue cutting. Likewise, the bank when we get to August. Fed certainly more uncertain, but you're just getting paid that little bit more to take on that duration risk in the US. And so ultimately, we still see that as being attractive because the direction of travel is end of cycle.
This is fascinating to me, this whole idea of market move in search of a narrative, which is something that we've seen consistently. And the part of the reason why we've been playing, market ping pong or table tennis with respect to different narratives. What narrative do you paint? End of cycle, rate cutting, go into duration, probably more heavily in Europe, less so maybe in the US, but still in the US, go into dollar assets. Is this basically the game plan that you've just been describing?
Yeah, ultimately, Lisa, it is. I mean, obviously, what we're not trying to do is make some bold prognostication on the macro outlook and then bet the farm. We're trying to think about the world probabilistically. We're trying to understand the various outcomes, the various scenarios, the various themes that are affecting market pricing, deduce what we think the market is assuming and position ourselves where it's most attractive, where the most asymmetry is. So the fact that you've got credit spreads as tight as they are and equities at the all-time highs and equity multiples looking very rich. Meanwhile, you've got yields broadly and particularly sort of 5 to 10 year yields looking pretty attractive relative to the dynamics which are being described broadly by the economic data. That as a starting proposition, as an asset allocator, that to us informs the idea that bonds, and particularly high quality, safe, defensive government bonds, are the more attractive medium-term investment proposition here.
A lot of people are looking to the data that we get today. John just went through it. And then on Friday, we get the non-farm payrolls report. A key question here has been how data dependent is this market? How data dependent are people like yourself who don't know what macro compass to really use? What's the more important data to really be looking at in the slew of information that we get today and also on Friday?
Yeah, then therein lies the problem, Lisa, because the data that matters the most, in our opinion, ultimately is unemployment, the labour market in general. That is the spine of the economic cycle. That's exactly how, these sort of positive and negative drivers feed through the economy in a cyclical fashion. The same dollar being spent multiple times that cyclicality. That's both, good in the upswing and then very negative in the downswing. And those changes largely happen because of changes to employment or changes to unemployment. But of course, that's the most lagging of those major indicators. And so it's difficult to make forecasts based on that. So you have to use the forward-looking data to try and inform a view on where the labour market is heading. And broadly speaking, this data has been telling us for a while and continues to tell us that things are softening, things are normalising. And again, the nature of the economy means that second derivative is incredibly important in trying to understand where a more medium trend is. So unless we see the jobs market picking up again, it still looks to us to be an economy which is losing speed.
James, we started this conversation and you were playing down the importance of politics in the United States. I just wonder how important the politics are, how relevant the elections are in the UK and France over the next several days. James, given that this Liz Truss shock seems to have become a self-imposed debt brake across the continent, just how relevant is the politics?
Yeah, and I think that's a really important point, John. I would note the same, that I think there's been a wake-up moment for UK politicians in particular, and I think it's good politics from the Labour Party to essentially shackle themselves to the kind of fiscal responsibility that the Tories were campaigning on. From an electioneering perspective, that neutered the Tories. Their chances of winning became virtually zero at that point. And ultimately, the lessons will live somewhat long in the memory, at least for the next year or so, I would have thought. In Europe, it's almost constitutional. You have fiscal rules still within the European Union, conveniently ignored during the pandemic, but they're starting to hove into view again. Excessive deficit procedures certainly are going to be part of the future. What that means for European politics, however, is less easy to say, because you have this rise of the extremes who really are ultimately sceptical with respect to Europe and the power of the European Commission. And of course, that could set some of these countries on a collision course with Brussels. Near term, therefore, there's a lot of event risk, but actually in Europe, medium term, I think there are more structural risks to bond market pricing.
So in other words, buy the dip in treasuries, in longer-term treasuries on political risk, maybe a little bit less so over in the Euro region just because of some of these structural issues. Is that right?
Well, certainly in the non-core, Germany is the safe haven. That's the core rates market. We do not favour owning a lot of the spread risk here because we think there are a preponderance of downside risks, and the market is not handicapping pricing those effectively at the moment. We'd like to see more spread before we'd be comfortable taking on some of those risks.
Hey, James, good to catch up, sir. As always, James Athey there of Marlborough Investment Management out of London. It's amazing from the market perspective how irrelevant the election in the UK appears to be in the next 24 hours.
In part just because, A, we kind of have a sense of how it's going to turn out, but B, the Liz Truss moment maybe hangs over a little bit more significantly in that nation. So in terms of fiscal responsibility or irresponsibility, that test is already passed through.
We said yesterday, nobody wants to be the bond crisis candidate. Nobody. And these populist parties, particularly in France, and you've seen this play out in Italy too, they want to prove that they can govern. And to prove that you can govern, you certainly don't want a messy bond market. So it has become, I think, a self-imposed debt brake across Europe. Whether it should have been, that's a completely different conversation, but that feels like where we are.
Except people are still saying that spread between French bond yields and German bond yields will persist. So, yes, it is a self-imposed kind of constraint, but to a point. And that, I think, is a hard thing that a lot of people are trying to get their heads around.
Well said. Yields a little bit lower over in France this morning. We're down 2 basis points. Equities here on the S&P 500, unchanged after closing at all-time highs in yesterday's session. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Donald Trump's sentencing in his New York hush money case has been delayed by 2 months to September 18th. The delay is so that judges can review the impact of the U.S. Supreme Court ruling on presidential immunity. It also means that the sentencing would come less than 7 weeks before voters head to the polls on November 5th. Trump faces up to 4 years in prison for the criminal case. And Eli Lilly has won FDA approval for its drug to slow Alzheimer's. The drug will compete with Eisai's Alzheimer's treatment, which has been available in the U.S. since early 2023. Lilly says the drug will cost $32,000 in the first year of treatment. Both drugs remove certain toxins from the brain and are only approved for early-stage Alzheimer's, which affects 6 million Americans. A check on Paramount shares rising more than 9% in the pre-market trade. David Ellison, Skydance Media, is said to have reached yet another agreement over Paramount. It rekindles deal talks that fell apart last month with a reportedly higher valuation. Skydance has a prelim agreement to buy Sherry Redstone's National Amusements and then merge it with Paramount Global. Sources say an agreement could be announced within days, though the deal could still fall apart. And that is your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the White House still trying to shift the narrative.
Extreme weather events drive home the point that I've been saying for so long. Ignoring climate change is deadly and dangerous and irresponsible. Unfortunately, my predecessor and the MAGA Republicans in Congress are trying to undo all this progress.
We'll get the latest on the program next from New York City. This is Bloomberg. Live from New York City, record finish at the close yesterday on the S&P, on the Nasdaq 100. Futures just about unchanged right now, no drama this morning. Yields just about unchanged at 442.37. Later this morning, about 2 hours away, tons of economic data, 8:30 Eastern Time. Tons of economic data throughout the morning. Mike McKee's going to be with us later to break that down for you. Under surveillance this morning, the White House still attempting to shift the narrative. Here's the latest. President Biden looking to ease concerns about his campaign, planning to meet with Democratic governors and agreeing to a televised sit-down interview. Biden also telling donors at a fundraising event that jet lag was to blame for last week's debate debacle. Isaac Boltansky of BTIG writing this. Social media post suggests that replacing Biden is as easy as changing a fantasy football lineup. But that concept crashes and crumbles against Biden's personal pride and the nomination mechanics. Isaac joins us now for more. Isaac, great to catch up with you, sir. We saw the leaks yesterday. It felt like the dam was breaking in more ways than one. I just wonder, looking at the polls, Isaac, do you think this gets worse, not better, for the president?
It's surely going to get worse over the next couple days. And I think that there is deep frustration in the Democratic Party over the White House's strategy after the debate. I mean, look, it's clear now that their strategy of downplaying this, deflecting and denying its reality has hurt them, and it's caused some of those fissures within the Democratic Party. So that strategy doesn't work. What I'm interested in is twofold. Number one, how does he look in the upcoming events? And I'm going to be looking at his appearance in Wisconsin on Friday, as well as that sit-down interview that you mentioned in the opener. And number two, what do we see from the polls? I mean, thus far, the polls have been deeply concerning for the Democratic Party and have also given the vice president a real inside lane among some Democrats. So those are the two things to watch from here until Sunday when that sit-down interview airs.
Isaac, can you think of anything like this? I just wonder how fixable this actually is. The way the party and the campaign talk about this is as if it's just a bad debate a la Obama-Romney from all those years ago. That's not what this was. This wasn't just a bad debate. This is about whether there's something seriously structural. And I can't think of a better way of framing the question than the former House Speaker Nancy Pelosi herself when she said, I think it's a legitimate question to say, is it an episode or a condition? How do they stop making people believe, Isaac, that this is a condition?
Yeah, look, I don't think they will. I think there's a part of the electorate now for whom this is their permanent and lasting view of the president. It's going to be very difficult to alter that. What the Biden administration is going to try to do is to say that he still has some gas left in the tank and he is a better alternative than the other guy. And this is something, John, that sticks in my mind more than anything else over the past few days, is that this race is different than ones that we've seen before, because it's incredible to me how disciplined the Trump campaign has been. If this was during the 2020 election, you would have seen Trump, concerned that the spotlight isn't on him, making it about him. Instead, he's been incredibly disciplined and let his opponent suffer with the headlines that he himself has created. And so I think that's another dynamic here that we've got to continue to watch, because ultimately that is why Joe Biden and those closest to him believe that he should remain the candidate, because he is uniquely capable of defeating Donald Trump.
Although he is a different man than he was back in 2020. And a lot of people have been saying that again and again. And the debate was sort of primetime viewing of exactly that dynamic. I just wonder what kind of timeline the current president is on to try to prove himself in any kind of way, given the fact that the momentum is building in his own party to tell him to step down. And the time is running out for actually nominating another candidate.
Look, I think that from where we are here in town, and the conventional wisdom is, let's see how the next few days go. Let's see how the next few polls go. What I'm telling my clients is I think Friday of next week is going to be the de facto deadline for seeing where the Democratic Party is. We've already seen the dam start to break in the comments from yesterday. Let's see how the chief of staff, Jess Zients, and what he has to say with his staff call today at 12:30. I think that's going to be a defiant tone. Let's see how we do in Wisconsin, and let's see how the interview on Sunday goes. All of that is then going to lead into the polling of next week. And I think by the end of next week, we're going to have a stronger feel as to whether this president is going to remain defiant and hope the story just shifts, or if we're going to be talking about a replacement, and we're going to be talking about some of the inter-party dynamics that are going to be at play now, 125 days before the election, that should have been at play 6 months ago.
You know, I got to say, it's hard for me to believe that this is going to quiet down. It feels like it's only getting louder. And yesterday was a cacophony of different Democratic Congress members, even with the first one coming out from Texas and saying, please step aside. You could see the polls that are really coalescing around this idea, with some people saying that the immunity ruling by the Supreme Court kind of turbocharged this feeling of frustration within the Democratic Party. Real question here is, what are the alternatives, given that Kamala Harris, Gretchen Whitmer, all of the potential replacements, Gavin Newsom, aren't polling that much better in a head-to-head against Donald Trump?
Lisa, this is one of the reasons that we have the situation we have, right? If there was a clear alternative, I think that there would have been more of a push within the Democratic Party 6 months ago to look at that alternative, right? But we didn't. And the party coalesced around Biden at the time. And that's one of the reasons that we're in this situation. From my perspective, I think that if we go to the next alternative, and if the president steps aside, I think that you have to look at the vice president as the clear, undeniable frontrunner. Two reasons for that. Number one is that I struggle to see the Democratic Party, a party that has embraced some tenets of identity politics, jumping over the first African-American woman in the VP role. That is not something that I see the Democratic Party doing. If they do that, I think that you're going to see some impact on voter enthusiasm. Number two, let's not forget there's $200 million plus in funds within the Biden-Harris war chest right now, and those funds need to be used by Biden or Harris. Now, of course, there's some ways around that, and that could take some time, but that is a complicating factor when we start thinking about what happens if Biden steps aside.
Just go through that, Isaac. I think it's really important, the mechanics here, the process. There's a bunch of money raised and only two individuals can use it. Is it that clear, that straightforward?
FEC rules are incredibly clear on that. Now, look, you could obviously have a return of those funds and then a new round of fundraising, so there's a way around it. But what I found interesting, John, is I think you're starting to hear some of the Democrats who believe we're going to have an open race for replacing Biden say Vice President Harris shouldn't be allowed to use any of those funds until she's a presumptive nominee. So you're already seeing some of that jockeying for the replacing Biden coming out in the fight over whether she could access the funds that have been raised for a Biden-Harris ticket. It's a lot of inside baseball, but it does show you, and I think bolsters Lisa's point, that this is getting real. And we've gone from the odds of Biden being the nominee being 90% to, just a little better than a coin flip now as we await what's next.
It feels very real. Isaac, thank you, sir. Isaac Boltansky of BTIG. Lisa, just to echo Isaac's words, it's not as easy as changing your fantasy football lineup going into the weekend. It's far more complex.
Which is the reason why you see a lot of jockeying now. And frankly, the idea of waiting till next Friday sounds like an eternity to me. It's not going to just all quiet down in the meantime.
Coming up on this programme, we'll catch up with SocGen's Kit Juckes. Not about rates, not about data, but about political differentials and what that means for this FX market. From New York, this is Bloomberg. Equities on the S&P 500 just about positive. Likewise on the Nasdaq after closing yesterday at record highs. Can we add to that? It's all about the economic data today. We switch at the board and get to the bond market. Yield shaping up as follows. Your 2-year 475.80, 10-year 442.57. You look at job openings yesterday, Lisa. We did not see the deterioration that maybe some people were looking for.
It inflected upward just a slight touch from the downward trend. People were expecting to go back to pre-pandemic norms based on a couple of measures. I will say there is a lot of question around the accuracy of this data. RBC put out this note yesterday saying that actually job openings are being skewed by baby boomers retiring. So there actually are more job openings now just structurally than there would be in a normal society. All this just go to say it makes these numbers difficult to get your hands around to understand where they fit in the macroeconomic backdrop.
If jobless claims keep climbing and unemployment does too, story's going to change.
Correct.
Forget job openings. Story's going to change and change very quickly. I want to talk about foreign exchange. Haven't mentioned it yet. Lisa's on top of this one. Dollar yen came really close to 192. Or rather 162.
I was about to say,
what ahead happened? Of myself, give it 5 minutes.
Yeah, exactly.
161.95. 161.95.
So there's this issue of what's going to sort of stop this freight train of yen weakening, given the fact that you've already seen maybe some intervention that failed completely. So why are they going to do that again, throwing good money after bad? But then this question of what if the Bank of Japan raises rates and it doesn't make a difference? And that's actually getting a lot of people nervous, including Vanguard, who's saying, if that happens, you could see 170. People talk about the actual differential when it comes to the economic trajectory and saying it actually fair value is something more like 120. There are enough people saying, we want to bet against you. We want to bet against the policy that you've been executing for the past couple of decades that doesn't make sense to us. Let's go. It's almost vindictive. I mean, you could just imagine these traders sitting around saying, take this.
Keep pushing. Keep pushing. Play out this exchange in about a month or so. Maybe we will be close to 192, coming close to 162. Under surveillance this morning, Fed Chair Jay Powell saying the latest data suggests the US is back on a disinflationary path. A slew of economic data coming throughout the morning, including ADP, jobless claims and durable goods. That sets us up for Friday when we get the big payrolls report Friday morning. And we've heard it from a couple of guests now. They're much more interested in the unemployment rate on Friday than they are in the payrolls figure, the headline number.
Given the fact that basically we don't have a real sense of what the normal level of the jobs created is to really create a fully employed America, I'm just curious, you asked me, did I think that Jay Powell sounded more dovish? And I really think this is significant, the fact that he came out and he said the economy had made, quote, significant progress, and another place had, quote, made real progress, and then quote, quite a bit of progress. He has a tone, and he basically wants to believe in the disinflation that he's seen, and he wants to believe that it's on the backs of something that is just sort of a cooling of the labor market that's positive. But either way, this sounds like a Fed chair that is preparing to cut rates soon.
It talked about two-way risk, talked about the resumption of the disinflationary trend. He also said that the strength of the labor market perhaps gives us the time to wait. And I wonder if that line was the bridge between July and September. Did you get that sense as well?
Yeah, that basically waiting was 2 months, right? This isn't exactly like he's talking about waiting for the rest of the year, but yes, explaining why aren't you going now? If you do see the disinflation, right, to Austin Goolsby's point, and that is your point, that basically if you do have an employment market that's strong, in other words, if we get 150, as you hear from Citigroup, does that mean they could cut this month?
Andrew Hollenhorst coming up. Look out for that conversation. Let's talk about travel. Big feature of the last couple of days. Big feature of politics, apparently, as well. Travel agencies warning of a surge in travel this holiday weekend. TSA expecting more than 32 million people to fly over the July 4th holiday, while the AAA is expecting more than 60 million people will drive. The numbers are staggering. We're talking about cracks in the labour market. If you're just looking at travel alone, there's nothing to see here.
This is the reason why it's so hard to get a handle around a macroeconomic narrative, just simply because when you take a look at travel, that has defied everything. Is it simply because people are still doing revenge travel? Is it still because people are prioritizing experiences? All I know is that yesterday, you actually saw oil reserves, the inventories of oil, go down. And this is interesting at a time of such big demand on a travel level. And it raises this question of, are we going to see that pop as a result of all of this travel maybe in the commodity space that we haven't really seen as of yet?
Speaking of travel, Back to the politics and travel. President Biden speaking at a campaign event in Virginia, sort of blaming travel, saying jet lag was to blame for his poor debate performance. Traders are now betting on higher long-term bond yields as they prepare for a second Trump term. Kit Juckes of SocGen writing this: any upward pressure on Treasury yields will simply strengthen the dollar further. That only changes when the economy slows and rates are coming down. Kit joins us now for more. Kit, based on your note in the last 24 hours, it sounds like you think, at least in the short term, for a currency pair like euro-dollar, political differentials are more important than, say, rate differentials and what's happening with economic data?
They are at the margin. I mean, in euro-dollar, yes, and dollar-yen, no. But taking half a step back, the underlying story is that, this is the third big dollar carry rally since I started work 40 years ago. The last two didn't end until the Fed had started cutting rates. And they both went far further than anybody thought they were going to at the time, including me, though I've got an excuse for the first one because I was in my first year at work. But and this feels the same. Then the politics comes in and changes things. I think I'd say one thing about the U.S. politics that I don't really understand because I'm not good at politics generally. But the big differentiator in this cycle is that the U.S. has had more accommodative fiscal policy for longer in the post-COVID era than the rest of the major economies. So Europe's been trying to get its fiscal policy under control. President Biden hasn't, and President Trump wasn't trying to, and doesn't sound as if he's going to try to really sort of, crack down on the budget. So the fiscal difference has been a big part of what we call U.S. exceptionalism, and has been a big part of the strength of the dollar. And it's been a big part of why the Fed has not been cutting rates, because the economy's been strong, because we've had no fiscal restraint coming out from the States. So yeah, I mean, the politics drives a lot, because the fundamental difference in the United States is that the U.S. can run this kind of fiscal policy, and the rest of us have to say Liz Truss every 5 minutes.
This self-imposed Liz Truss debt break seems to be sort of gripping the whole of Europe right now, Kit, including France. France is a big conversation too. I want to talk about France and political risk in France and what it means for spreads and what it might mean for the FX market too. I want to do a little bit of a recent history lesson as well and go back, say, 10 plus years. Let's go back to 2011, Kit. I think if you have some young people on your team over at SocGen, trick question for them if they haven't watched this conversation. Tell them where spreads were in Europe back in 2011, say Italy, Spain versus Germany. Then ask them what they think the euro averaged that year. Because as you know, the euro averaged that year close to 140. And Kit, I just wonder how relevant the political risk that's starting to infect spreads is to the FX market in a single currency, because it was very complex back in 2011. It wasn't obvious. What is it now?
I mean, at the moment, the market is looking at, clearly, spreads have moved more than the euro has by a significant margin. And I think that's still, the thing that's different now from back then, in a sense that Mario Draghi did his thing then and reassured everyone that we're not letting this thing break apart on the back of that, and he stabilized the bond market. I think if I'm being fair, the stability in the bond market is a little bit unsure of itself, but we're back at 2017 levels in OAT bond spreads now, so it's still holding in. So there's a long path between where we are now and to if you like, life in 2010, 11, 12, certainly before 2015, and then the kind of the really big changes that we saw. So, we're kind of okay, provided this doesn't get significantly worse in terms of fracturing Europe potentially. So we'll have to see how that plays out. But what we've done so far is we've had a wobble in the bond market and not quite nonchalance in the foreign exchange market, but the foreign exchange market is saying that the euro is pretty low down here. This isn't a reason for us all to panic. A lot of people were short already. What I do think it does in the interim is this is going to cap where the currency can rally to for the rest of this year, for sure. In other words, the upside on euro dollar, for anybody who thinks it's cheap down here, I can't see how it gets a good lift against this backdrop.
What's the floor then, Kit? How far could it go if you see some of the political fractures escalating in France and even potentially in Germany?
We got in the short term. We got to 95 in the teeth of the biggest terms of trade shock, negative for Europe and positive for the United States in your or my or anybody else's lifetime around at the moment, frankly. So the euro is very beaten up against the dollar down here, and I don't think we're going to get down to parity, in the next 12 months. For the sake of argument, you'll need an escalation in terms of at a European-wide level. You need to be talking about the future of Europe with genuine concern for us to get to that. We're not there. We're not there yet by any stretch of the imagination. Yeah. So we're probably where we are now is anchored at the bottom end of a historic range. Worried about the long-term lack of growth in Europe. Worried about European excess savings departing for better returns in the United States every day of the week, but not panicking on a currency base.
You point to this idea and sort of finishing up where we began, this tension between the actual economics of the moment and the rate differentials versus the politics of the moment. You say that the one big catalyst could be actually downside for the dollar should the economic trajectory weaken dramatically. This morning you said the market would need to see something closer to 150,000 in payrolls on Friday and an ISM services read that we get later this morning, closer to 50 to get really excited and start selling the dollar. What kind of downside risk do you see for the dollar, upside risk for the euro, if you get some sort of scenario like that?
I think over time, quite a big one. I mean, back to these big carry rallies, but if you think that the U.S. didn't have a recession until the Clinton recession after the $85 rally, so 85 rally, it doubled in value against the German mark back then, and then it halved on the back of Fed rate cuts without a recession, which is, both moves were ridiculously huge. So there's part of me that says the carry trade that's in, if we call it that, the amount of the way the United States corners all of the world's excess savings because the U.S. is a better place for them to be. If that flow starts going back the other way, the dollar can fall further than I can imagine. But the caveat on that is, if you've got a rate cycle in the U.S. that was kind of one or two rate cuts and then they're done at a higher level, then maybe that doesn't play out because I've only got sort of two instances in the history of these huge moves. But it does strike me that if the U.S. looks like it's slowing and the market gets the bit between the teeth on rate cuts and the Fed delivers rate cuts, then there's a bit of a snowball movement because every dollar bear has been beaten up in the last 2 years.
Hey, Kit, great to catch up, sir, as always. Kit Juckes is SocGen joining us on the phone there to break down the latest over in Europe and stateside as well. Euro dollar right now, 107.60. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Jamaica's prime minister has declared the entire island a disaster area ahead of Hurricane Beryl's landfall. The storm could cause over $1 billion in damages as it moves west through the Caribbean Sea. Beryl's winds have slightly weakened from a Category 5 hurricane to a Category 4. It's expected to continue to lose strength, but there's also risk that a weaker Beryl could spiral into the Gulf of Mexico next week. And Bloomberg has learned that Anglo American is weighing options to push ahead with the sale of its coal business after an explosion at a flagship Australian mine. Sources say this may include selling individual assets or excluding the damaged operations. The plan to exit coal was part of a dramatic restructuring announced earlier this year as Anglo fended off a takeover pursuit from BHP. And it is the last day of campaigning for the UK elections, and during which former Prime Minister Boris Johnson has made a last-minute campaign push to rally Conservative voters in support of Prime Minister Rishi Sunak. Labour leader Keir Starmer dismissed the strategy as desperate. Bloomberg's composite poll of polls has seen Labour ahead of every other party by at least 20 points. And that's your Bloomberg Brief. John.
Danny, thank you. We'll touch base with Danny in about 30 minutes' time. Up next on the programme, the Fed seeing progress.
You can see the labor market is cooling off, appropriately so, and we're watching it very carefully. We have the ability to take our time and get this right, and that's what we're planning to do.
Citi's Andrew Hollenhorst up next from New York City. You're watching Bloomberg Surveillance. Equities just about unchanged on the S&P 500. Record highs at a close yesterday across the board on the S&P, on the Nasdaq this morning. Futures going nowhere. Yields not doing much either. 442.77 on a 10-year. And foreign exchange, the euro just a little bit stronger here. 107.62 against the US dollar. Under surveillance this morning, Chair Powell seeing progress.
We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. You can see the labor market is cooling off, appropriately so, and we're watching it very carefully. We have the ability to take our time and get this right, and that's what we're planning to do.
So here's the latest. Investors looking ahead to a slew of economic data this morning. ADP at 8:15 Eastern Time, jobless claims 15 minutes later. All of that ahead of payrolls on Friday. Andrew Hollenhorst of Citi saying this: we see mainly downside risks that are 155. We're forecasting risks that a 4% unemployment rate are more balanced, but the Fed's response would be asymmetrically dovish to a higher reading. Andrew Johnson around the table. Andrew, good morning to you.
Good morning.
Let's start with Friday. Let's skip today, and then we'll sort of work backwards. 155 with the downside bias. Unemployment at 4. Can you just walk us through how you're thinking about unemployment now? Is that the more important data point?
I think so. So we have a lot of questions about the payrolls numbers. They just continue to come in much stronger than forecast and much stronger than what we're seeing in a lot of the other labor market data. You've heard some Fed officials even starting to say these payroll numbers look a little bit out of step with what we're seeing other places. So
including Chairman Powell.
Including Chair Powell. The nice thing about the unemployment rate is it's a ratio. So you don't have to get the labor force right. You don't have to get the population right. You're just trying to figure out what's the percentage of people who are out of work, and that number's going up.
Implicit in that analysis, are you suggesting that one survey is better than the other?
I think there are pros and cons to both surveys, and what we would have said until 6 months ago is usually it's that establishment survey payrolls number that's the better number on a monthly basis. It has less volatility month to month. That's why that number gets so much attention. But because we're in a labor force environment where we've had immigration, we've had big shifts in the labor force over COVID, we may be getting some things wrong in the establishment survey. Firms that are being born and firms that are going out of business, getting those numbers right. The household survey, at the end of the day, you call people, you ask them, are you working, are you not working? We know the percentage of people who say they're not working.
You think that there's going to be a recession starting in the second half, probably starting in September, and that's probably underpinning some of your calls for more aggressive Fed rate cutting heading into the end of the year. And yet yesterday we saw JOLTS come out, job openings come out more than expected. We've seen record travel amounts. We were just talking about that with what airports are expecting for this weekend. We see people continue to spend pretty dramatically. How do you explain that noisiness?
Yeah, it's a mixed data environment, and that's typically what you see when you're going through an economic transition. You're going to get some stronger numbers, you're going to get some softer numbers. I think the interesting thing in the JOLTS numbers are, yes, job openings have come down, and they basically stayed at the same level, came up a little bit in the number that we saw yesterday. But the interesting point is that we're back in terms of the ratio of job openings to unemployed individuals. That ratio, about 1.2 openings for every unemployed individual, back to where we were pre-pandemic. And what you tend to see is this behavior where once you start pushing job openings below that level, the unemployment rate starts rising more rapidly. And we heard Chair Powell talking about it yesterday. We may be at a kind of inflection point in the labor market where you're actually going to see more weakness on the unemployment rate, in job growth, as we continue to push those openings lower.
People have been talking about this inflection point, and Jay Powell, as John was noting, talked about how the potential here is that they have time because the labor market is strong. Would that 155 signal to them they no longer have time? Time's up. They have to make a move.
I don't think that it signals time's up, you have to make a move. It does raise those concerns, and that's what we heard very clearly from Chair Powell yesterday, that we had been in an environment where risks were unbalanced. It was really just about upside risk to inflation. If it's all about upside risk to inflation, you know you need to raise rates, you know you need to leave rates higher. Now there's this balancing act that's playing out where Fed officials are thinking about upside risk to inflation, but downside risk to the labor market. Goolsbee, a little more dovish, Chicago Fed president, we heard him saying, I'm seeing warning signs. So Goolsbee is going to see that 155,000 and say, we should have cut back in June. I don't think Powell will be there, but 155,000, that's probably the kind of number where Powell would say, okay, things are slowing down. We're getting balance between our employment mandate, our inflation mandate. As early as the FOMC meeting at the end of this month, we should be signaling towards that rate cut that's upcoming now.
Andrew, a lot of people are using this word normalization. Let's work backwards. I said we'd work backwards. Payrolls. Let's come to where we are today. Let's get to jobless claims. Can you walk me through what's normal post-pandemic and what would be the danger zone? What's the difference between the two?
Yeah, so we've been in these levels of initial jobless claims. We're running about 230, 240 right now. If that number moves up to 260, that's when you start to get a little bit concerned. And we do have some momentum upwards on initial jobless claims. You can't really compare the level to prior cycles because states are always changing the rules about who's eligible, how do you qualify. It's really the movement that you see. We're up about 30,000. If you're up 50,000, then that's when we start to worry.
If you wait for that, are you late?
Usually, that is what you see is that initial jobless claims can be a leading indicator, but they're often more of a contemporaneous indicator. And I think that's where, in fairness to Chicago Fed President Goolsbee, that is where you look at those numbers and you say, okay, 2 weeks from now, we could be another 20K higher, and then we will wish that we had been a little bit more dovish earlier.
I want to overlay the politics on this because there is sort of an existential fear underpinning some of the Feds trying to get this right, that if they don't get this right, and if there is some sort of serious recession, the response function from the fiscal side isn't going to be there in the same way. Is that your assumption, that essentially if we go into a recession that is deeper, it is going to be that much harder for the United States to get itself out without causing interest rates in the long end to go up much more considerably?
And so we have a relatively low unemployment rate, 4.0%, and we have a quite high deficit as a percent of GDP. Usually what you see in macroeconomic policy is that that deficit comes down when the unemployment rate is low. And so that does create a concern that if the unemployment rate starts rising, well, then that's when deficits usually go up. You want to spend to support the economy. It's not clear there's as much ability to do that in the current environment. Now, if we get a very deep downturn, I'm sure there will be political consensus, doing a fiscal package. The danger zone really may be, is it a kind of more mild downturn? Is it this conversation that we're having around the table this morning where some people are saying we're seeing warning signs, other people are saying, well, no, things are really pretty strong. If you're in that environment, there's not going to be political consensus on doing more fiscal policy, especially in a world where we're already running a high deficit.
That's where some people say the Fed put comes into play. The Fed has actually now 5.5 percentage points to cut, which is very unlike the pre-pandemic level. I keep asking people this, and I don't have a real answer, which is how much and how effective can the Fed be with their rate cuts, given the fact that people don't think that the rate hikes had that big of a slowing effect on the economy?
Yeah, it's a great point, Lisa. Of course, when you reduce interest rates, that's going to stimulate the economy. It's going to bring down interest rates for some borrowers. But to your point, as we all know, it's a 30-year fixed-rate mortgage economy, and that means that when interest rates rose, for a lot of households out there that own a house, they did not experience the effect of those higher interest rates. And so when interest rates come down, you also don't experience that. And the other thing that's going on is 10-year Treasury yields are below 2-year Treasury yields, which is already reflecting an expectation that the Fed is going to be cutting interest rates. So the Fed just starts cutting interest rates now. It's not clear that 10-year yields fall that much. And then we're having this discussion about deficits. We're having a discussion about continued inflation. Those things would keep 10-year yields higher. Most economic activity is going to be more responsive to a 5-year yield, a 10-year yield. It's not really about the overnight policy rate. So there really are questions about how much can you transmit that stimulative effect of lower policy rates.
Andrew, it's good to see you.
Thank you.
Have a happy July 4th.
Yeah.
Thank
happy
you,
4th
sir.
of July to you.
Andrew Hollenhorst there of Citi. I think the fact that that is even an open question, that if we go into the next economic downturn and the deficit gaps wider and we don't know if Treasury yields rise or fall in that situation. I mean, that's been a given for a long, long time. Yields fall, Treasuries rally, people gravitate towards fixed income, core, sovereign fixed income. The fact that we think that's an open question, that's a big change.
It's also a huge change that we had a massive counter-cyclical fiscal stimulus that increased the deficit at a time where the economy was really going quite strong. That, I think, is also unprecedented. When you take a look at the debt levels relative to GDP, that is unprecedented. A lot of aspects really defy some historical precedents in the United States.
The conversation continues. Up next on the programme, we'll catch up with Jordan Jackson of JP Morgan. We'll speak to Charles Myers of Signum Global Advisors. Sticking with Biden. We'll get more on that big donor in just a moment. Tom Tzitzouris of Strategas on this bond market, and Bloomberg's Anne-Marie Hordern live from Ukraine, from New York City. This is Bloomberg.
There's parts of the market that could be allegedly overvalued, but this is backed up by a strong economy, good earnings, good consumption.
Quality factor and the momentum factor, frankly, have been just dominant in the U.S. equity market.
The earnings outlook from at least a market-weighted perspective is still supportive of those risk assets.
Business and the consumer are doing what they should be doing. They're showing up.
People are simply doubling down on existing bets because they think this party's going to keep going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide, with equity futures just about positive after closing at all-time highs in yesterday's session on both the S&P 500 and the Nasdaq 100. We've got quite a morning coming up for you. Let's go through it together. Let's talk about the day ahead. The day ahead looks like this: ADP, jobless claims, ISM services, Fed minutes. In just a moment, you'll hear from the New York Fed President, John Williams. Lisa, we're packing that into a shortened trading day. The stock market closed at 1, the bond market at 2.
So where's the signal and where's the noise? A lot of people looking to a two-pronged aspect here, a two-pronged show, starting with the initial jobless claims and then going to ISM services. Those two economic metrics really setting the stage for non-farm payrolls on Friday. When you start to look at the potential for services also showing the weakness that we saw in manufacturing, that can move the needle.
I'll keep going back to the framework we've used on this program now for a number of months. What is the difference between a welcome cooling and an unwelcome deterioration? Andrew Hollenhorst of Citi on the program just moments ago pointed directly to jobless claims. We asked for a number. He gave us one. He said the danger zone would be 260. 235 is the estimate today. 260 is the danger zone. And we said to him, if you wait until 260, are you late? And he said, basically, you're late.
I mean, that's what we heard yesterday from Claudia Sahm as well. When you start triggering some of these rules, and you start triggering some of these points, you've already blown it. And that's, I think, what's on the likes of Austin Goolsby's minds when they start having a more dovish tone. Question is, you see other aspects like the fact that travel is at record highs. It challenges the idea of weakness. Nonetheless, if you see a broad-based cooling across the board, even if you don't hit those trigger points, is that enough for a serious change of tone at the Federal Reserve?
That's the market and the economy. We will, of course, talk about the politics as well. Think about what we've heard in the last 24 hours. The polls, the leaks, the excuse, the new one is jet lag. Just think about what the rest of the world is thinking right now about what's developing in the United States of America, what foreign leaders are thinking about this situation. Anne-Marie Hordern, if you're wondering where AMH has been over the last couple of days, I can reveal that all to you right now. She's going to join us in about 30 minutes or so. She's been sitting down in Ukraine with the Ukrainian leader Zelenskiy. And I'm sure, Lisa, I know, this was a part of the conversation.
There is a real question about American leadership at a time where there's some real questions about the sitting president and his ability to keep running and who might be in his stead if he decides to step down. This is clearly a concern. We've heard this from the NATO chief. What is the American role if you don't have necessarily strong leadership at the top? The White House has said there is strong leadership. The president is still very much involved. We've heard this from Netanyahu, from the NATO leadership, from some of the unnamed European leaders who've met with him on the overseas trips.
So in about 30 minutes' time, we'll play out some of that interview for you and we'll catch up with Anne-Marie on the ground in Ukraine. Look out for that exchange a little bit later this hour. Equity futures right now on the S&P 500 just about positive. Your scores look like this, and the bond market yields just a little bit lower by not even a basis point at 442.57. Euro dollar at 107.60. The one to watch though in foreign exchange, the Japanese yen. Lisa, here we go, getting closer to 162 at 161.93.
Vanguard saying that the real test will be if the Bank of Japan actually makes a move and hikes rates. And that still doesn't stem some of the weakness that we've seen in the Japanese yen, that they could see that getting to 170 in terms of the dollar versus the yen. They're not getting a break from the U.S. political scene that somehow has given extra juice to the dollar. And that's really the ultimate question for them. How much do they need a friend in Jay Powell? And frankly, in the U.S. electoral cycle that has not given them anything close to that.
They haven't got many friends right now. Japanese yen, the weakest going back to 1986. Coming up this hour, here's your lineup. Jordan Jackson of JP Morgan as the S&P 500 notches another all-time high. Charles Myers of Signum, global advisors on the road ahead for President Biden. And Tom Tzitzouris of Strategas on Treasury uncertainty under a second Trump presidency. We begin with our top story. The S&P 500 closing above 5,500 for the first time ever after Fed Chair Jay Powell said the US is back on a disinflationary path. JP Morgan's Jordan Jackson writing this: the strongest a getting stronger, but they're fueled on veggies and complex carbs, not short-term stimulants. Yes, valuations remain a concern, but investors can diversify into sectors like materials, financials and healthcare, which are expected to see a very strong earnings rebound in the second half. Jordan joins us now for more. Jordan, good morning. It's good to see you in New York. Thanks for being with us. Let's just talk about it. You seem pretty constructive on this equity market into the second half.
I do. As I mentioned, the strongest are getting stronger. When you think about the Magnificent Seven, as a share of the overall S&P 500, 39% of R&D spending, 23% of free cash flow, 16% of S&P 500 capex. When you think about a lot of these companies are also the AI hyperscalers, they're expected to spend close to $200 billion in investment spending. So, you talk about first quarter earnings growth, year on year, up 50%. These are strong businesses. By the way, they're generating some interest income on their balance sheets, and they're making so much money, they're issuing shares or they're buying back shares and issuing dividends. We've never seen this before coming out of growth companies. So I get excited about that side, while obviously valuations, as I mentioned, are a bit of a headwind, but also for the rest of the market. When you look at the strong earnings rebound coming from materials, healthcare, financials by the fourth quarter of this year, I think this helps to broaden out and provides at least some durability in this equity market rally.
The one-year move in the Mag 7 has been amazing. The Mag 6, you strip out Tesla, it's been pretty phenomenal. Are you saying we should worry about diversification, we should worry about concentration risk, or we shouldn't worry about it?
I'm saying we should be mindful of it, careful about valuations, right? And when you think about a risk budget within an equity portfolio, you want that to be, you need that exposure, right, to some of these companies. But I also think you want that sort of value defensive areas that look to be seeing some promising earnings growth expectations.
If we do see the economy weaken, as we were just talking to Andrew Hollenhorst of Citigroup, and he's expecting that to really percolate out in the data, particularly around employment, are all bets off? Is the sort of healthy diet of complex carbs and protein sort of now suddenly looking a little bit more like Twinkies?
Well, it's been interesting. When you look at growth holistically, it hasn't been very sensitive to movements in the Treasury market. Yields are higher, but growth is higher as well, and the market continues to hit all-time highs. So I do think perhaps they may be feeling a little bit more defensive than they have historically. And also we're in the camp that growth is cooling, not freezing over. And I think that's a really important dynamic as well. So I don't think all bets are off. And even if the economy slows, this could be a soft enough recession where it's almost difficult to say it's an outright deep recession.
There's sort of an interesting idea underpinning what you just said there, which is something that we've been hearing from people. Basically, how much a Treasury is going to be the haven bid at a time when people have been hiding out in NVIDIA. People have been hiding out in growth stocks that are minting money. That has been sort of the acyclical bet on something different. Is that sort of what we can expect this time around? If we see economic weakness, if you see the labor market start to roll over, that's not going to stop the freight train of NVIDIA, of Microsoft, but you could not maybe see the same kind of rally into longer-term treasuries just because of the deficit and some of these political issues.
Sure. I certainly think there's a bit of a put on long-term interest rates. We actually think that yields are probably going to be in a pretty tight corridor for the duration of the year, from about 4 to 4.5%, and we're already flirting with sort of the higher end of that. When you think about that floor, you've got rising estimates of R-star. You've got, I think, this also increased pricing as of late, perhaps a Trump victory, and he's talked about in tariffs, right? Baseline tariff. He's talked about, certainly he's going to push through all the expiring provisions on the 2017 Tax Cuts and Jobs Act. That's all going to be net inflationary. And I think the bond market is starting to feel that. But that said, if you do get a more material slowing, I do think you're going to get long-end Treasury yields rallying a little bit here. And perhaps, though, interestingly, in the next recession, and if it's a deeper recession, maybe balance sheet policy is going to be more important than interest rate policy. That back end, the Federal Reserve impacting long bonds and long rates.
Let's just sit on the long end. So you've got this range of 4 to 450. I think your rate cut call for this year is only one cut for 2024. Implicit in that is basically an inverted yield curve for the rest of this year. Do you think that the Trump presidency has the potential to change that, given the bear steepener that we've seen over the last couple of days? Just this steepness starts to come through, but driven by the back end.
You've already seen a little bit of that bear steepening kind of play out, really since that peak inversion since July of last year. And the steepening has really been happening at long rates, kind of moving higher relative to where we were in the middle of last year. I do think, though, the next steepening out that we do see is going to be a bull steepening. So I do think it's going to be the market. As soon as the Fed starts cutting rates, the market tends to jump the gun. and they may very well start to price in more aggressive rate cuts, and that's going to bring the front end of the curve down. But I don't think the curve is going to be positively sloped, perhaps into the second quarter of next year, maybe even not until the second half of next year. So I think this is going to be an environment where the yield curve is going to stay inverted. In that environment, you need to perhaps maybe barbell the yield curve from a duration standpoint, and I'd probably assign 65%, 35%. That 35% a hedge against the risk that something more sinister plays out in the economy.
I like how you looked at Lisa when you made that point.
I know.
Thank you. You know this program well. Jordan Jackson at JP Morgan. Jordan, it's good to see you. Thank you, sir. If something sinister happens, Lisa.
I know, exactly. I know that I sort of come up with the catastrophic scenarios. Literally, I sit at home sort of, worrying about catastrophic situations.
You write them down.
I do. What happens if the yield doesn't go down in the face of weakness? Yeah.
I'm ashamed to say that when I lived in London, Anne-Marie used to bring back Twinkies for me from New York.
So you ate Twinkies?
I actually ate some Twinkies.
Do you have pictures?
Yeah.
Pictures, I don't believe you.
I don't know if I have pictures. I'm sure they're still in my body somewhere. It's a long time ago. Still trying to digest those Twinkies.
Yeah, stashed in your left leg. Look,
That's
this to me,
disgraceful.
I just wonder, getting bigger in the diet of complex carbs and protein. There is truth to that, right? It's sort of been vaguely healthy. What happens to change that?
Okay. All right. Okay. We've been serious again now. All right. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Bloomberg has learned that Apple is getting an observer role on OpenAI's board. Sources say that App Store head and former marketing chief Phil Schiller has been chosen for the position. They say the arrangement will take effect later this year. The move puts Apple on par with Microsoft, which also has a non-voting observer role. Apple earlier announced that it would offer ChatGPT in the iPhone, iPad, and Mac as part of its AI features. And Donald Trump's sentencing in his New York hush money case has been delayed by 2 months to September 18th. The delay lets judges review the impact of the U.S. Supreme Court ruling on presidential immunity. It also means the sentencing would come less than 7 weeks before voters head to the polls on November 5th. Trump faces up to 4 years in prison for the criminal case. And Anne-Marie Hordern sat down with Ukraine President Volodymyr Zelenskiy and asked him what it would take to win the war with Russia.
I would like China to play a serious role. It's a big country, and really it's the second largest economy, and Russia really depends on it because they don't have another place to export many of their goods because of the sanctions.
And we'll bring you more of Anne-Marie's interview with President Zelensky in about 15 minutes' time. And that's your Bloomberg Brief, John.
Danny, thank you. Looking forward to catching up with AMH at about 7:30 Eastern Time. Up next on the programme, the dam begins to break.
He has a bad night. Now, again, I think it's a legitimate question to say, is this an episode or is this a condition?
Is it an episode or a condition? We'll get you an opinion on that next. From New York City this morning, good morning. Equities right now in the S&P 500 just about unchanged. Record highs at a close yesterday. Let's see what Wednesday's got in store. So far for Q3 though, gains on Monday, gains on Tuesday, just about unchanged on Wednesday. In the bond market, yields unchanged at 442.96. The bond market has not been looking at the data or the Fed speak over the previous few days, particularly Friday and Monday. This bond market was staring at one thing, the latest in the election in America. Under surveillance this morning, the dam beginning to break.
He has a bad night. Now, again, I think it's a legitimate question to say, is this an episode or is this a condition? And so when people ask that question, it's completely legitimate of both candidates. Both candidates owe whatever test you want to put them to in terms of their mental acuity and their health. Both of them.
So here's the latest. Pressure mounting on President Joe Biden to prove last week's debate was just a bad night. Worries in the Democratic Party growing after Puck News published a leaked poll which showed Biden's favorability ratings plummeting the most in nearly 3 years. Major Biden donor Charles Myers of Signum Global Advisors writing this: "I'm all in on Biden. His performance in the debate was weak, but his performance as president for 3.5 years has been very strong." Charles, I'm pleased to say, joins us now for more. Charles, great to catch up with you, sir. As you know, for many people, after Thursday night, it's not about the last 3.5 years. It's about the next 4.5 years. And let's run with the Pelosi question. How do we know that was just a bad episode and not just a condition?
Yeah, look, I think the president and his team have a lot of work to do to get him out there to show the American people that he is fit, that he is alert, and that he can not only run the rest of this campaign, but that he can govern the country for another 4 years. So, again, I think that they do have work to do. I think what Nancy said is absolutely accurate. And the things are moving a little faster than I expected. I thought they'd have about at least 2 or 3. We were telling our clients they'd have 2 or 3 weeks of polling before they would have to make a decision. I thought, this is a personal opinion, I think they've got probably another 5 to 6 days. I think that things are moving much faster against the president, and we'll see. But they are getting him out this weekend into the swing states, and we'll see how he does on the ABC interview with Stephanopoulos.
What do you think Chelsea needs to accomplish in those 5 days? What does he need to do?
I think he needs to be unscripted and show people that he is fully there and can make decisions, interact with people. I was with him on Friday night in New York, one-on-one at a big event, but then had about a 3 to 4 minute interaction with him one-on-one. He was very together, very alert. So he needs to show that to the American people instead of this perception that has been lingering of him post-debate of someone that is, really out of it.
Charles, isn't the damage done, given the fact that people are really questioning whether they're being told the truth, especially from some of his advisors? And you have a number of Democratic congressmen, including one from Texas, now verbally saying that they hope he steps down. Does that mean that there already has been too much to shake his reelection chances?
Yeah, so I'd say a couple things. One, the campaign expected polling, to take a hit, and the puck stuff that was leaked, was pretty damaging. But again, I think you need to see more than just one poll. You need to see a set of polls over a week or so, and see if they can turn it around. But yes, I think a lot of damage was done. I'm fully on board with that. I understand it. So far, only one sitting member of Congress has called for him to step down. I do think that could be the next shoe to fall, though. Meaning, there's reporting this morning that there's potentially 40 additional elected Democrats that are going to come out and call for him to step down. That is probably the most serious issue, that in addition to further deterioration in polling, because once you've got, elected members of your own party asking you to step aside, it's hard to recover from that.
There's also a question of who potentially would take his place. And this has been one of the arguments from some people who are saying that, he's the best shot, sort of to your point, because the other potential candidates, whether it's Kamala Harris, whether it's Gretchen Whitmer, whether it's Gavin Newsom, kind of pull similarly in a head-to-head matchup with Donald Trump. Do you feel like there is sufficient polling to really make that decision, given the fact that some of it isn't that extensive?
Polling to make a decision on who should replace him, or if anyone should replace him?
Both.
Okay, so yes, so on Plan B is absolutely the vice president. I'm here to tell everybody that, and that she may not be the favorite of every donor. A lot of donors come from financial services, and we tend to be a center-right industry. But any notion that the White House, the DNC, or the Democratic congressional leadership is just going to overlook the vice president and go to some other candidate or have an open contested convention, I think is a misread of the situation. The whole point of the vice president is to step in the case of death, incapacitation, resignation, or in this case, the president stepping aside. And I can tell you they're going to try to do everything they can to avoid a contested convention, given what happened in 1968. LBJ's VP did ultimately win that nomination. He was so weakened, they lost the White House to Richard Nixon. I think that if Biden steps aside, they will try to engineer it so that Kamala, the vice president, ultimately locks up the nomination.
Charles, I think it's worth pointing out to our audience that you're wearing 2 hats in this conversation, as both a donor and an individual running a global advisory firm. And forgive me for saying this, and I hope you take this in the spirit in which it's intended. When you said you had a 5-minute exchange with him, when it's behind closed doors and you tell people that he's sharp, cogent, these are things we've heard a million times, and then we all see him in public, and not just Thursday night, for a length of time now, and we see something else. And I just wonder how much tension there is between you as a donor and the opinion you offer on a program like this and the kind of advice that you're giving to clients right now.
Yeah, so I'm giving the same advice. You know, we've had a base case that Biden would win. We haven't changed that yet because he's still in the race. And you know, Thursday was less than a week ago. So, you know, as a firm, we don't whip our calls around. We want to, you know, try to look at data and make a good assessment. The reason we thought the reason we believed he would win is he'd already beaten him once in 2020. He's got the power of the incumbency. And we think as a firm, we will see higher than average turnout by both women and the Democratic base, women because of abortion rights and Democrats because Trump's on the ballot. Now, I think the race has changed fundamentally since Thursday night. Absolutely. We want to see if he's going to stay in the race before we make any additional call from here. So I'm sitting here both as a donor watching this very closely, but also as the head of a firm that advises clients on what to do. I think it's hard to make a decision until we have a little more clarity on what the president intends to do. And I think, as I said, we were telling clients yesterday on a call that we thought there was 3 weeks for the White House or for the Biden-Harris campaign.
Yeah.
I think they've got 5 or 6 days to make a decision.
Let's lean on the latter just a little bit. Your position as an advisor, can we just lean on that a little bit more? I want to understand from your perspective. Traditionally, the incumbent would have some advantages. I just wonder if it's actually a disadvantage for Biden. If you think about how 2020 played out, he got to make this a referendum on the former president. This feels like a referendum on him. And not what he's delivered in 3.5 years, but whether he can last 4, whether he can actually keep this job for that long. How do they change that?
Yeah, I think that's going to be the hardest part of the narrative to change, because I think up until Thursday, this, in fact, had been still partly a referendum on the former president, on Trump, as opposed to the sitting president. Now, I think it's really a referendum on can the sitting president not only campaign for the next 4 months, but can he serve for 4 more years? And relatedly, what do people think of the vice president? So again, I think in politics, everything is fair. The race changed fundamentally on Thursday night. And, as I said, I think we're going to find out in the next 4 to 5 days whether the president is still in this race. I don't think he's got 3 weeks.
The dam is breaking, as John said, when it comes to different Democratic Congress members, when it comes to advisors, when it comes to people who are starting to leak their feelings to a number of different outlets. Is the dam breaking within the inner circle of Joe Biden that we keep hearing about, that keep saying, keep going, run?
So no, I'm not part of the inner circle, but I would, from everything I'm seeing and picking up, is that no, the inner circle, which is his family and his closest advisors and the campaign team who've been with him a very long time, still absolutely believe he should keep fighting. Again, this is a man who's dedicated his entire life to public service and reached the pinnacle of world power. To drop out after a really bad debate or a terrible stumble on the campaign trail, it would be highly unlikely. By the way, I wouldn't advise any politician to drop out after that. There's always a chance to turn things around in a campaign, and they're trying very hard. It's just that, again, the pressure is building faster on him to drop out of the race. And I think that that's probably been a bit of a surprise to the campaign. And I think we will see more electeds coming out saying he needs to. And the biggest risk in a way is his liability down ballot, right, with elected Democrats in vulnerable seats, both in the House and the Senate, in really tough races. That's where we're hearing, and I'm hearing, the most pressure and much more panic, actually, than amongst the donors.
I've got 30 seconds left on the clock. Charles, just to fit this in, do you think people are underestimating Kamala Harris? It's almost become a joke.
Absolutely.
Do you think she can win?
Absolutely. Oh, absolutely. Look, Kamala Harris has 3 advantages. One, she'll be totally underestimated. In politics, having low expectations is one of the greatest advantages you could have. Secondly, she gets all the Biden-Harris money, which is not able to be transferred to any other candidate. So she gets the war chest. She'll be very well funded. Third, look at her approval rating with Democrats, 84%. She's much more popular than the president with young voters. She's very popular with black voters, and she'll help drive women, turnout by women. I think people will totally underestimate the vice president. I'd put my money on her.
Let's do this again soon. Charles, thank you, sir.
Absolutely.
Charles Myers there of Signum Global Advisors. There you go.
When you look at Predict It, she now has a 32% chance of winning the presidency versus a 68% chance of Donald Trump.
The change in the betting markets, it's been amazing, hasn't it?
She's basically a better chance right now than Joe Biden.
From New York City, this is Bloomberg. 45 minutes from now, we'll have some data for you. The ADP report is just around the corner. Then after that, 15 minutes later, jobless claims in America. So about 60 minutes from now, we'll get some claims data for you. The scores going into it. Futures doing absolutely nothing on the S&P 500. Likewise, on the Nasdaq. Talked a lot about the shortened trading day for those of you that missed some of the time. So the stock market closing at 1 p.m. today. The bond market closing at 2. Let's check out the bond market, switch up the board and get to Treasuries, and we'll start with a 10-year at 442.96. Yields doing nothing there at the 2-year level. We're up a basis point or two to 476. And we had this conversation with Andrew Hollenhorst of Citi earlier, who talked about this asymmetric bias of maybe Fed officials towards incoming economic data, that if you get softer labour market data, it's more likely you're going to get a cut and quicker from this Federal Reserve.
The question now is, what's the bar for truly soft data? Some people pointing to the unemployment rate creeping up from that 4% level. Other people just saying you'd have to have a 155,000 print on jobs created, and that would be enough. That's why I think the rhetoric from the Fed is actually getting more interesting. For a while, it was kind of, and now it's actually getting more interesting because you could see there is a feeling of wanting to buy into the progress of disinflation that we've seen so far.
The other challenge in fixed income, and we've talked about this repeatedly, it's not just for bonds, it's for stocks too. It's the whole market. You're looking ahead to 2025. You're flying absolutely blind. I'll pick up on what RBC's Laurie Calvasina said in the last 24 hours. Upgraded a price target for 24. Basically said there's too much fog going into 25 to offer any guidance on a price target for 2025. That's where we're at right now. Now think about how things changed from Thursday night. All of a sudden, we're having a very realistic conversation about Kamala Harris being the nominee for the Democratic Party. And all of a sudden, you've got to think about a different set of policies, a different cabinet, not just the incumbent versus the known entity of Donald Trump and what that would mean for markets. All of a sudden, you're having a completely different conversation almost overnight.
So last night I was thinking about this and I was saying, if you would have had this on your bingo card, people would have said, all right, you're one of those people that says they're going to call up Jamie Dimon and see if they can come, if he can come down and serve as president. And yet here we are. And we just heard from Charles Myers over the Democratic donor as well as a strategist saying Biden has 5 to 6 days. And then he has to basically make a decision. And that's essentially where we are. You're right. Talk about flying blind in the market. Even if you know who the candidates are, how do you assess what their policies are going to be and the ramifications for the economy?
With great difficulty. You've got to push that through stocks, through bonds, work out what it means for the US dollar. We know what the consensus is on the US dollar. Donald Trump wins. We've got this idea that it's going to be quite protectionist, more tariffs, maybe inflationary. Ultimately, that's going to keep the Fed from cutting interest rates, perhaps in the short term at least, and that's going to feed this stronger dollar story. The euro right now is at 107.58. The other side of the trade, we've talked about that lots. We have an election like right now. Second round of the vote is going to be over the weekend in France.
And that comes after the UK election that's coming tomorrow, at a time where there's really a question of how far can populist governments push things in Europe. If, let's say, Marine Le Pen does get some sort of majority, which it's looking like she may not because of a whole host of different technical aspects, how far could she push it before the market pushes back? And we keep talking about that. I just wonder if we could just take a step back and say it is all about the economics, stupid, right? I mean, that's essentially what people say for the politics of the moment. And all of a sudden we're saying it's the politics, not the economics. At what point is Matt Miskin right when he says, ultimately, you just have to look at what the trends are. They are disinflationary. They are going to be slower growth. And that is the dynamic you're going to really have to factor out.
It's going to be a really long 4 months.
I know.
Let's put it that way. The euro, 107.59. Under surveillance this morning. The latest on Donald Trump's fundraising is all surpassing President Biden. The former president raising more than $330 million in the second quarter, dealing another blow to Biden as his campaign faces ongoing criticism over his debate performance. Lisa, you mentioned what Charles Myers said just moments ago. He said we've got 5 or 6 days. He thought maybe we'd have 3 weeks. But we've said it repeatedly, the dam's been breaking in the last 24 hours in quite a material way.
Yeah, and to that point, he thought that he had 3 weeks, and he was telling that to some of his clients 1 day before changing his tune to saying maybe they only have 5 to 6 days. The other thing that he said that I thought was really interesting was that he's expecting about 40 Democratic Congress members to come out and reiterate what we heard from that Texas progressive, basically saying maybe Joe Biden should step aside for someone to take his place. Real question will be for the Democratic Party, if he chooses to do so, whether there is this groundswell of support around one candidate and whether that one candidate will be Kamala Harris. And then we can start to extrapolate out all the other questions, but really talk about the next 4 months and how quickly some of the narratives can shift when you potentially have a different cast of characters at the head.
This late in the game, it's all about the money. and we've heard it repeatedly, there's only one individual on the ticket that can have access to that money. Everyone else, how quickly can you put a campaign together, raise the money, get the financing in place, go through all the mechanics involved? This is what Isaac Boltansky at BTIG was saying about an hour ago. This is not straightforward. It's not like you just sit here and say, yeah, Gavin Newsom, let's go. It's not that straightforward.
Yeah, I wonder how much it's a money thing, because they could potentially give the money back to the donors, and the donors could potentially then give it to another candidate if you coalesced around it. And I wonder how much is this political, because ultimately of the optics of Kamala Harris not getting the nomination when she is technically a number 2. She is a black female, and it would be particularly difficult for the Democratic Party to push her aside, shunt her, and still maintain a lot of support from a groundswell of people.
That's the latest on that front. We've talked a lot about the politics. We've talked a lot about the individuals. We need to talk about some of the policies that will address things like this. Owning a house in the US is less affordable now than at any time in the last 17 years. Higher expenses and mortgage rates hovering around 7% have outpaced incomes as a shortage of listings pushed the median home price to a record high, $360,000 US. This according to a new report. The pursuit of the American dream is traditionally something we'd be talking about repeatedly going into a November in an election year. This needs to be part of the conversation again.
I actually think this absolutely is part of the political scene, especially for younger people who don't have access to home buying in any kind of way. And you see rent prices going up in a significant way. How do you address this when you're dealing with a lot of NIMBY, not in my backyard, in terms of development? How do you address this when you have mortgage rates where they are and prices that haven't gone down? We've seen this from Joe Biden. It's really going to be a key question of how it changes the electorate in terms of what people are looking for and what galvanizes them.
Just a final story for you. This from Defense Secretary Lloyd Austin saying the United States will provide $2.3 billion in new military aid to Ukraine. Austin met with Ukraine's defense minister at the Pentagon just yesterday ahead of the NATO summit in Washington next week. Of course, as I repeated a little bit earlier this morning, Anne-Marie sat down with the Ukraine President Volodymyr Zelenskiy a little bit earlier, and she's going to be joining us a little bit later. Just one headline from that particular story. Lisa, Zelensky challenging the former President Donald Trump to reveal his plans to end this war and end this war quickly. And I can share the quote with you. If Trump knows how to finish this war, he should tell us today. He told Anne-Marie, if there are risks to Ukrainian independence, if we lose statehood, we want to be ready for this. We want to know.
And that's going to be a real question, considering the fact that Donald Trump has said that he could end this in one phone call. Really key to this is some of the discussion that we see between Russia and China, which is currently ongoing because the Russian and Chinese leaders are set to meet each other in a meeting out east.
Just working on getting that conversation going with Anne-Marie. She's going to be joining us in the next couple of minutes or so. Elsewhere, traders loading up on short-term treasuries after former President Donald Trump came out ahead of President Biden in last week's debate. Tom Tzitzouris of Strategas saying this. There's a narrative going around that the pop higher in yield is because of Trump's raising odds of taking the White House. We find this to be a convenient boogeyman for what is otherwise a combination of long-term structural forces and short-term liquidity drivers that are all pushing up yields. Tom joined us now for more. Tom, can we go through the list of things? Takeaway Thursday night. What else is on that list?
Yeah, well, in the immediate term, the list of things pushing Treasury yields up is that, simply put, there's been a drop in liquidity in the system as households and corporations have paid taxes heading into the end of the second quarter. We estimate that there was about a $400 billion drop in liquidity, much of it coming out of bank reserves. And when you see $400 billion come out of bank reserves, you're likely to see interest rates rise very short term. Now, we're past that now, but the market also has to focus on the fact that the deficit continues to be gargantuan. The deficit missed the estimate. We're still printing $2 trillion plus deficits. And into 2025, that's likely to come down, but not enough so that the market can just kind of breathe a sigh of relief here. So we're going to have to see coupon auctions rise as the deficit continues to print to the upside. And that's going to be a long-term problem for the bond market. And the bond vigilantes are sniffing that out today. They're not waiting until they find out who's in the White House.
Well, let's talk about who might be in the White House, Tom. How relevant is that conversation? You say it's convenient boogeyman right now. Just beyond that, what have you been telling clients about the last couple of days?
Well, I'm not sure whoever's in the White House is going to have much of an impact on the deficit in calendar year 2025. It's really 2026 and beyond. And that's going to really also come down to who controls the Senate. If you have full Republican control, then yes, it's very likely that you're going to have a little bit more pressure on the deficit, upside on the deficit, because of the pressure to cut taxes. If you have a divided government, what we find historically over the last, we'll call it 50 years, divided government is a little bit more fiscally conservative. So Senate control matters just as much as the White House. But my base case would be that we're going to see some extension of the Trump tax cuts no matter who's in the White House. And we're going to see this deficit continue to print at least above $1 trillion for calendar 2025 and 2026. So big picture is, I think, that we're going to see upward pressure on yields because of the deficit for years to come, irrespective of who's in the White House.
Given that, Tom, do you still see 10-year yields ending just north of 4% by year end?
We do, and the reason for that is because in the intermediate term, we'll say 6 to 9 months, we are in a disinflationary environment, and the Fed funds rate is still, by last check, 5.5%. So we're still tight policy, particularly for most U.S. households. Policy is tight in an environment where the labor market is slowing and inflation is slowing. So I would absolutely expect that, for example, Friday's jobs report, the jobs report's always the gold standard in economic data. That should show a further slowdown in the economy. And that should further add to the narrative that inflation is going to continue to slow as the summer progresses and into the fall. So that's how we justify 10-year yields dropping down to 4%. But the question is going to be, how much lower than 4% can they go, one, without a recession? And if there is a recession, then how much lower do they go? Without a recession, I don't see yields dropping much more than down to 4%, maybe a little bit lower than that.
Maybe we can talk through the end of this year, but in 2025, how much visibility do you have to actually make a forecast at all, let alone, have any conviction?
Not a lot of visibility, to be perfectly honest with you. The big drivers, again, that we see that we are absolutely confident in is that coupon supply in the Treasury space is going to rise, and that the deficit is going to be at least $1 trillion plus next year. That's what we have most confidence in. Next level confidence is that we're going to continue to see some sort of disinflationary progress into early next year, and the Fed is likely to cut into that. That is pretty much where our clarity ends, because tariff policy, tax policy, everything you can think of, regulatory policy is all up in the air at this point in time, and so is a complete question mark.
Hey, Tom, great to get your thoughts. Tom Tzitzouris there of Strategas on the latest in Washington and what it means for this bond market. Let's get you an update on stories elsewhere with your Bloomberg brief. Is Danny Berger. Hey, Danny.
Hey, John. A check on Paramount shares this morning, up nearly 12% in the pre-market trade. David Ellison, Skydance Media, is said to have reached yet another agreement over Paramount, rekindling deal talks that fell apart last month with a reportedly higher valuation. Skydance has a preliminary agreement to buy Sherry Redstone's National Amusements and merge with Paramount Global. Sources say that it could be announced within days, though the deal could still fall apart. Now, oil is trading near a 2-month high this morning on signs of a significant down draw in U.S. crude stockpiles. The American Petroleum Institute reported that crude inventory shrank over 9 million barrels last week. If confirmed, that would be the largest drop since January. Crude has remained solidly higher this year with a whole lot of risks, including hurricane season with Hurricane Beryl approaching Jamaica, global elections, and geopolitical escalations in the Middle East. Travel agencies are warning of a surge in travel this holiday weekend. The TSA expects more than 32 million people to fly over the July 4th holiday, while AAA is expecting more than 60 million people driving. And that is your Bloomberg Brief. John.
Danny, thank you. Up next on this program, do not miss this. Anne-Marie joining us after she sat down with Ukraine's President Zelenskiy. AMH live from Ukraine. Up next. Equity futures right now on the S&P 500 totally unchanged. Let's just park the markets just for a moment and catch up with our colleague, good friend, co-host, Anne-Marie, who sat down with the Ukrainian President Volodymyr Zelenskiy a little bit earlier in Kyiv. AMH, fantastic work. Good morning to you.
Good morning, John. My big three takeaways from this interview is one, that President Volodymyr Zelenskiy, having watched the debate, heard what former President Donald Trump said, is potentially ready to sit down with him. He said it'll be tragic for Ukraine if they don't know what comes if former President Trump was to win in November. We also talked about the state of the war. He doesn't like the word stalemate or deadlock. He says the problem is Russia can track if they were to have a counterintensive, because the weapons have been so delayed coming from the United States, even though he was very grateful to the U.S. Congress for recently signing off on the $60 billion. And then finally, John, one thing that I really took away from this conversation, if the war to end, I asked him about a third-party mediator. Who can actually mediate the end of this war? You'd think it would be someone that has credibility in both Russia and Ukraine's eyes. He actually said it needs to be the United States and China. Let's take a listen to the state of the war at play right now from the president of Ukraine, Volodymyr Zelensky.
We've had agreements about ceasefire between Ukraine and Russia, and Russia has been always breaking all the agreements and has been killing our people. So only if it's on some international forum in the presence of the countries, leaders who are trusted. They might have different ideas, different views on the stages, how this war will be over, but we all have to be on the same side. We have to trust each other. Trust is very important. The Peace Summit, by the way, has shown that we can follow this plan. Over 100 countries were there, and today we're talking about their nuclear security and energy security, and there will be a clear plan. So the ceasefire also needs a clear plan. We must understand that Russia would not be using ceasefire to simply accumulate equipment on the territory, our territory that they've occupied, because we will not be striking them. I mean, they can use that to create a strong fist here and then accuse us of breaking the ceasefire and start another invasion. So it's really complicated for us. It would take a significant loss for us if they invade again, as in the beginning of 2022, when they have almost reached the capital city. And they accumulated a lot of equipment on the territory of Belarus. And Belarus kept saying that, no, it's just the exercise. No occupation is in mind. It's just the training. It's just military games. It's very important. I really don't want to have this big trouble for my country, because we are at war already. Giving the advantage to Russia now, it's just impossible. We need to be smart, and it's important also who will be responsible for this, besides the Ukrainians who are paying with their lives. Which country will be responsible? It's easy to just talk about ceasefire, but it's very difficult to enforce it, to keep it. It's very difficult to find those who will respond why the ceasefire
But we're going to
was
see
broken.
more calls for a ceasefire, especially as the world politically is moving to the right and potentially moving to the right in the United States. You have said this war is dependent on U.S. aid. I want to ask you, did you watch the presidential debate between Joe Biden and former President Donald Trump?
So, first and foremost, the ceasefire is an important element in any plan to finish the war. So, a ceasefire is not finishing the war. We've been there. It would be just a frozen conflict. And it would be frozen for the aggressor, because it would be frozen on our territory, and our people would be under the occupation. This gives a clear advantage to one side. That's why it's easy to offer different proposals of ceasefires. But what's important? It's important to find answer what would come after. It's the matter of not just the victory. There are many people talking about ceasefire, and it's fine that people are talking, but what would happen next? That is the question. For example, what's the next step? What's the third step? What would be the step when Putin breaks the ceasefire? After the ceasefire, a month after the ceasefire, will he pull out the troops out of Ukraine? Who guarantees that he will pull the troops out of the occupied territories? And there's silence. Nobody has answer. I'm not accusing. I just want to explain that we are at war and we understand this. So, the debates.
Well,
I saw
because
debates.
the answer of how this might all unravel will depend on also who's at the table from the United States.
Amongst other things, it might depend on who is the president of the US. Yes, that's a fact. Because the US, the United States of America, today are probably the most powerful player. So the matter whether the United States would be the major international player, whether they want that, or they want to focus more on their internal politics. I cannot say, it doesn't depend on me.
So did you watch the debate?
Yes, I watched the debates. So, first and foremost, I want to say, I don't know, maybe it would be out of tune to what we see in the US media, but I watched, and we are not electing the president of the US, so I didn't look at the incumbent president and the former president. I looked at them in terms of Ukraine.
President Trump said he'll end the war before he's elected.
Yeah, I heard
What do you make of that?
Я скажу честно.
Let me be frank.
Давайте, наприклад, це вирішує.
For example, well, the decision is on US public. But let me just have some reasoning. Так, але для вас це важливо. Yes. So let us imagine that the winner might be Trump in November. And he knows how to end the war. He has a plan. Me, as the president of a country at war, not a theoretical person, but a real-life person, I would like to be prepared. We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? Tomorrow, do we want the war to be over tomorrow? The war didn't to start. It was Putin who started it. But I hope you agree that it would be fair. If Trump knows how to end this war, he should tell us today, because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone.
Looks like President Zelenskiy is ready to sit down with former President Trump, given his comments, Jonathan and Lisa, at the debate. When it came to President Biden, he was very careful with his words about his deteriorating health. He didn't really want to weigh in. But I will tell you this. When I asked him, Zelenskiy, who's 46, if he would still do his job at 81, his face said it all. He gasped. He laughed. He said a lot of individual things matter about that. Who's on your team? What's your health? And, of course, he wanted to make sure everyone was aware that Ukraine is also a country at war.
Anne-Marie, just a brilliant exchange. AMH, just congratulations from all of us here at Bloomberg for your work and to the team on the ground in Kyiv today. We'll catch up with Anne-Marie in about an hour, again, to go through some of this. Lisa, just a decent idea, just from Anne-Marie at the end there, of how the rest of the world were responding to what this country saw take place on Thursday night.
We heard about it in terms of private conversations with different leaders, basically saying they are worried. And this raises the question of the real on-the-ground consequences of Thursday night's debate if it is not sort of rectified in terms of perception for the sitting president for the next 4 months, let alone 4.5 years.
So let's get you set up for the next 1 hour. I can't do the next 4.5 years. The next 60 minutes or so. Here's the lineup for you. Sonal, Desai, Franklin Templeton, Geetha, Ranganathan of Bloomberg Intelligence. We'll speak to Thomas Simons of Jefferies and Mark McCormick of TD Securities. We'll catch up with AMH before we close out the programme as well. Lisa, the data starts. ADP in about 20 minutes. Then it's on to jobless claims at 8:30. ISM services a little bit later, Fed minutes. There's a lot to talk about later on today.
Especially at a time where you've heard from guest after guest about a tipping point, a potential tipping point in the labor market. When do we start to see that? We didn't see that in JOLTS yesterday. Do we see it today? Do we see it on Friday? That's what people are watching for.
That conversation in the third hour of Bloomberg Surveillance from New York City this morning. Good morning.
The Fed is certainly cognizant of the fact that it is nearing the end of this rate hike cycle.
The Fed has been effective in reintroducing balance to the labor market. But my concern is whether or not the pendulum swings too far.
The labor market has normalized rather than weakened sharply.
Initial jobless claims still at around 200,000 is fine. When it gets to about 300,000, that's when the Fed is going to have to pivot hard and start to cut.
The labor market has weakened. That window is closing to get ahead of that risk.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Got some good news for those of you absolutely sick and tired of the political conversations. Next 45 minutes, largely political free, because the focus is going to be on the economic data. In about 15 minutes' time, the ADP employment report drops. The appetizer for the main event, the main course on Friday, payrolls. The estimate in our survey, 165. The previous number, 152. We'll bring you the actual number in just a moment. Then at 8:30 Eastern Time, Lisa, jobless claims, 235 the estimate, 233 the previous number.
You pointing out earlier that Andrew Hollenhorst of Citigroup saying that the pain threshold was around 260,000. If we get that number of initial jobless claims, that is sounding warning signals creeping higher. How do you interpret that? And that is how I'm curious in terms of the market reaction. Is there a bigger response to a small upside surprise in initial jobless claims given the asymmetry right now of the Fed response?
Two quotes, compare and contrast. First quote from Chairman Powell. Listen to this. Because the US economy is strong and the labour market is strong, we have the ability to take our time and get this right. Federal Reserve Chairman yesterday. Also yesterday, former Fed economist Claudia Sahm. Take a listen to this one. A good labour market is not a reason to wait. Remember when she said this? The reason to cut is that inflation is down considerably. A good labour market is what is at risk if the Fed doesn't. Your best friend Neil Dutter of Renmac. Neil said this for a while. The Fed speak is starting to feel offside relative to where the economic data is coming in the labour market.
So here's the issue, and this is something that Claudia Sahm did a great job highlighting yesterday. She nailed the Sahm rule, which is basically a certain amount of increase in the unemployment rate over a certain period of time always indicates recession. She said if the Fed waits until that gets triggered, they are too late. You are already in a recession and they have to get ahead of it. Which brings us to the inflation point. Neil Dutter, as well as Claudia Sahm, pointing to the fact, and also Austin Goolsbee, we should say, saying that basically the more inflation comes down, the more restricted the Fed gets, and it's unclear whether it's necessary. That, I guess, is really the question that I have about services, and the reason why I'm focusing on ISM services. Does it show ongoing strength that could suggest inflationary pressures down the pike, or does it also sound more of the all clear that Jay Powell was trying to coalesce around a little bit more?
That comes at 10 a.m. Eastern Time. Look out for that economic data. The broader price action looks like this in the equity market on the S&P 500, largely unchanged through most of this morning. Just about unchanged again on the S&P. It will be a shortened trading day. I've gone through the times a couple of times. It's worth doing again just in case you missed it. 1 p.m. the stock market closes. 2 p.m. the bond market closes. Lisa will tell you that's because the bond market and bond traders work harder. I'm sure lots of you disagree with that. But ultimately, that will be the take from fixed income. What did John Stauffer say about bond traders yesterday? What did he say?
Just want attention. They're looking for attention from the Federal Reserve.
Okay.
They're just driven by ego and the day-to-day. And I got a lot of response from that, actually. And some people said, yeah. So
I'm sure you did. Bit of news on some personnel moves. This coming out just moments ago that JP Morgan chief market strategist Marko Kolanovic is set to depart the firm. That crossed in just moments ago on the Bloomberg terminal. The JP Morgan chief market strategist Marko Kolanovic to depart the firm. The JP Morgan price target in the investment bank on the S&P 500. Last time I looked, Lisa, it's in front of me now, 4,200. That's from Dubravko Lekos-Bujas. Michael Klinovic's had a difficult time calling this equity market over the last couple of years.
Both on the way up and on the way down at a time where there's a real question of whether there could be some sort of recession. They see yes. And then what the read-through is to a financial market that has been upheld by artificial intelligence, as we heard earlier, from a JP Morgan strategist, global market strategist, how the pillars of this market are really being held up by complex carbohydrates and protein, considering some of the euphoria, and not Twinkies, the euphoria around the likes of NVIDIA and other AI darlings.
Your line. And not theirs, of course. Coming up this hour, Sonal Desai is going to be joining us, Franklin Templeton, as Chair Powell says the Fed needs more confidence to cut. We'll speak to Geetha Ranganathan of Bloomberg Intelligence on Lisa's favourite story, Paramount and Skydance reaching a deal. And Mark McCormick at TD reacting to today's jobs data, 8:15 for ADP, 8:30 for jobless claims. We begin with the big issue, Powell and the path to 2%. Sonal Desai of Franklin Templeton saying this: incoming economic data is starting to show a cooling that is likely welcome news for the Fed. There is growing space to cut rates before the end of the year. The market is now pricing in a cut in November and likely another one in December. More importantly, I expect this next rate cutting cycle to be short and shallow, absent some exogenous shock. Sonal joins us now for more. It's not great to catch up with you. We can go through a lot of that. Let's just start with the short and shallow piece of the call. What's short and shallow? How short, how shallow?
I think that the end point is not in the threes. I think it's more like 4, 4.25. It's been my call for a while now. I don't agree with Fed Governor Williams. I definitely don't think that the neutral rate is going back to 2% less than the pre-GFC level. I think the neutral rate is around 2, 2.5. And that means with inflation at 2, Fed funds neutral should probably be at around 4, 4.25. And that to me is short and shallow, going from where we are right now to that point. Absent exogenous shock means absent essentially something which causes a recession, is what I would say.
Do you think maybe the Trump candidacy has the potential to cause that? You knew it was going to go there and go there early. Do you think it has the potential to?
So, here's the thing. I think there's so much of focus on the Trump candidacy versus the Biden administration, lots of focus on a blowing up of the fiscal deficit. Holy cow, we're looking at 7% this year. And we're looking at the last 3 years of fiscal deficits, which are enormous. They are enormous by any stretch of the imagination. These are massive fiscal deficits. And that happened in the environment of a split House-Senate administration. I think we should not underestimate the U.S. government's ability to run deficits under pretty much all scenarios. So I would say that is the Trump administration going to be notably worse than a Biden administration? We don't know enough about the policies, to be honest. And I will say this, that every time we talk about expansion of tax cuts, it's important to recognize that there's been a tax promise on the part of the Democrats, and that is not to increase taxes for those making less than $400,000. And most estimates show that's a substantial part of the Trump tax cuts. They were disproportionately targeted towards high-income earners, but in sheer quantum, a large amount of the cost of those tax cuts comes from people who will hopefully continue to be protected into the next administration, regardless of who comes in.
So let's put the two ideas together. This idea that the neutral rate is 4 to 4.25%, and the idea that there probably will be a propensity to spend, regardless of whether it's a split Congress or whether it's an all-Republican Congress. Does that mean that the 4 to 4.25% neutral rate that you're kind of gaming out has a political implication based into it, just based on the deficit? That is the premium for where the deficit is, or is that without that kind of added on? In other words, could you be gaming out 5% 10-year yields or north of that based on just the deficits alone on top of that neutral rate?
Oh, well, absolutely. 10-year yields, but I'm not talking about that in the near term because, we've got to think about the medium to long term and the near term. And I talk short and shallow cutting cycle mechanically, the Fed cuts. I think long end yields react. I don't see massive reduction in long end yields. I've been calling for this particular range we're in since the start of the year, and I think that's how we end this year. I don't anticipate during a Fed cutting cycle to see a massive ratcheting up in long end yields. But if we are looking at post-cutting cycle, the Fed is running at around 4, 4.25. Absolutely, long end yields would be north of 5, 5.5, and potentially, north of 5, or even 5.5, depending on how that deficit picture plays out. So I want to distinguish between what I think about in the next year or so of cutting cycle and then post-cutting cycle, year and a half, once we get to the cutting cycle.
You know,
Does that make sense?
Yeah, that makes sense. So basically, there's sort of two time frames here. There's sort of the question of, yes, cuts, but not that far, and then what you could potentially see down the line and the lack of visibility, the fog of 2025. A question here on what this means for credit, given that before the pandemic, people said never would we see benchmark rates get above zero, and if we ever did, certainly to this level, you would see a rash of defaults. That really starts to get tested as Survive to 25 gets, sort of outdated, and suddenly you have companies really have to exist in this time frame. How much does this benchmark neutral rate that you're looking at challenge the concept of these bullish calls on credit, given how tight spreads have gotten?
Corporates have been, if I talk about the broad swath of corporates, they have actually been, I would dare I say, surprisingly prudent. Because remember, it wasn't Survive till 25. It used to be this year was going to be the wall, the maturity wall. That maturity wall keeps getting pushed out because corporates have, in an important way, refinanced, and they have managed. I think we need to look at the underlying economic fundamentals, which I don't have a baseline deteriorating massively. If that doesn't happen, I think actively choosing corporate risk still looks like a pretty viable way to go, but you have to be active. Clearly, the cushion in terms of spread has contracted massively at this point.
Sonal, we've got to leave it there. It's good to get your thoughts, as always. Sonal Desai there at Franklin Templeton on the bond market. Shout out to Liz Kappa McCormick, who just got hold of this note from Jan Hatzius of Goldman. Trump's tariff proposals could raise the average US tariff rate by 16 percentage points to nearly 20. Net implication for monetary policy? Take a listen to this. It's the Goldman view. Hawkish to the tune of 130 basis points because the large hawkish inflation effect clearly outweighs the smaller dovish growth effect. It's quite a call. It's about 5 hikes.
Which really raises the issue of how you can get ahead of 2025. I'm just sitting here internalizing that kind of idea. Why we were talking to Sonal Desai about what that benchmark neutral rate really takes into account. Would it have to be that much higher? Does that limit the rate cutting cycle that the Fed can really engage with?
We're going to see more notes like this, that's for sure, over the next couple of days. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden's favorability number saw the largest single-week drop in nearly 3 years. That's according to a leaked memo from a pollster published yesterday by the news site Puck. Biden's debate performance last week cemented concerns about his age. The memo says a number of alternate Democrats now perform better in the polls against Trump than Biden does. That includes Transportation Secretary Pete Buttigieg, Michigan Governor Gretchen Whitmer, California Governor Gavin Newsom, and Vice President Kamala Harris. Owning a house is now less affordable for average earners in the U.S. than any time in the last 17 years. In the second quarter, a typical home cost rose to over 35% of the average U.S. wage. That's the highest since 2007 and up 32% from last year, according to a report from Athey. Pricey markets in the West and Northeast had the biggest declines in affordability, including Orange and Alameda counties in California and Brooklyn and Nassau County in New York. Travel agencies are warning of a surge in travel this holiday weekend. The TSA expects more than 32 million people to fly over the July 4th holiday, while the AAA is expecting more than 60 million people will drive. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the programme, we'll get you some morning calls plus. Geetha Ranganathan of Bloomberg Intelligence as Skydance and Paramount reach a preliminary deal. Can we really close this, finish it, and kind of move on?
I think some people want that to happen.
Yes, some people called Lisa from New York City. That conversation up next. This is Bloomberg. It has just gone 8:15 Eastern Time in New York City, and that means we've got an ADP report for you. With those numbers, it's Mike McKee.
Good morning, John. Well, I'm not sure how you take this number. 150,000 jobs in June, according to ADP. Now, remember, ADP measures only private sector employment, and that 150,000 is pretty close to what we got, what we are expecting from the non-farm payrolls number, private sector employment on Friday. According to ADP, annual pay up 4.9%. That's a little more than the Fed wants to see. In terms of job creation, largely in the services sector, 136,000 there. In terms of manufacturing, a loss of 5,000 jobs, 27,000 construction jobs were added. And this is large establishments, 58,000, medium establishments, 88,000, small businesses only added 5,000. Now, we've seen in the small business report that companies are still reporting it's hard to find workers for small businesses, so that may be part of it. But all in all, this is kind of a middle of the road, I guess you'd call it, ADP report. They, of course, say they are not a forecaster. It's not a forecast. It's just a separate number from payrolls tomorrow, but everybody will sort of mark that into their books.
So, Mike, let's look ahead to the data through the rest of this week, through the rest of this morning. Jobless claims in about 13 minutes. We'll get the ISM employment component at about 10 a.m. Eastern time, going into the payrolls report on Friday. What would you look for from claims and perhaps more specifically, Mike, continuing claims? What's to learn from that over the last few weeks?
Well, what we have seen over the last few weeks is it's getting harder to get a new job if you've lost yours. Continuing claims have continued to increase. We've seen some volatility in initial claims, but they are higher than they were 3 weeks ago. So does that continue? Do they stay higher? Does it suggest that the labor market is definitely slowing down? That's what we'll look for at 8:30. 10 o'clock in the services employment aspect of it. This ADP report showed a lot of service sector job hiring compared with other sectors. Does that show through in the ISM numbers? We can sort of reconcile those two things. And, of course, at 10, we'll be looking at the headline for ISM services. It jumped last month. We'll see if there is still that kind of strength in the service industries.
Just sort of to lead forward to Friday, all of this is sort of the big drumbeat to Friday's non-farm payrolls report. And we've been playing around with the idea of what would it take to really change the tone on the Federal Reserve, to really bring forward a July rate cut, to lock in a September rate cut. What are you hearing in terms of expectations? Right now we're looking for the creation of something like 190,000 in terms of jobs created in the month of June. What would the threshold have to be to really change the narrative on the Fed?
Well, I don't think it's going to change the narrative on the Fed. It may change the narrative on the Fed in the markets because we still have some inflation data to come with CPI and also the PCE numbers before the Fed's next decision. But the markets are probably looking for something south of 150 to more or less bring September into play, although other data could move that sooner. Anything north of the 190 is going to push September maybe off the map. And remember, the 190 that we're anticipating this week was pretty similar to what we were anticipating for the May payrolls report, and it came in at 272. So there can't be a lot of confidence in what the consensus is at the moment.
Hey, Mike, great to get your thoughts. Mike McKee of Bloomberg. He's going to be back with us in about 10 minutes' time when we break down jobless claims. ADP coming in at 150, the estimate 165. Jobless claims, 235 is the estimate. Previous week, 233. We'll get those claims for you in about 10 minutes. Let's get you some morning calls. Let's start there. First up, Wedbush raising its price target on Tesla to 300. Analyst Dan Ives saying the demand story has taken a turn for the positive and highlighting his new bull case of 400 for 2025. We're up another 2% on Tesla. Next up, Deutsche Bank lowering its price target on Nike to 92. The analyst pointing out that more investor patience is needed thanks to steep sales revisions and a weak Chinese market. And finally, Raymond James maintaining its market perform rating on Paramount. The analyst saying, quote, if we have learned anything from the Paramount process, and to quote Yogi Berra, it ain't over till it's over. Geetha Ranganathan of Bloomberg Intelligence joins us now for more. Geetha, how close are we to this one being over?
No idea, John. I mean, to say that we've seen this movie before multiple times is an understatement. I mean, this has had more twists and turns than, a race course, really. So we'll see what happens. But again, I have to see it to believe it. And, just 3 weeks ago, this deal was completely struck down when Shari Redstone walked away. It looks like they have some new merger terms. But again, if there's one thing that we know about Shari Redstone, it's that she is completely unpredictable.
You say just 3 weeks ago. Just yesterday, it was Barry Diller going in for this as well. Geetha, what's going on?
Yeah, a whole lot of players obviously on the scene here. We know as of yesterday that Skydance is back in the mix. Of course, this was the one party that was negotiating very, very aggressively with the Redstone family. Again, that deal kind of completely fell apart 3 weeks ago. But in the meantime, there have been so many other different bidders who've expressed interest for National Amusements, which is the controlling shareholder in Paramount. Yes, you mentioned Barry Diller. He's expressed some interest. Of course, he's a huge digital media conglomerate. There have also been some reports about Edgar Bronfman being interested, as well as Stephen Paul, who is a Hollywood financier. But again, we really don't know what's going on. And there are all kinds of different dollar values here. In terms of Skydance, they've come back with $1.75 billion. That seems like it's slightly lower than where initial news reports had pegged them at, which was about $2 billion. But then I think when the deals were falling apart, it was probably closer to maybe $1.7 billion. So maybe this is slightly better than what they had initially offered. But I think the main thing that we're seeing here is there is stronger indemnification language. And this is something that Shari Redstone has been really concerned about. She's been concerned about lawsuits just because the Skydance deal is going to favor her over all the other Class A as well as the Class B shareholders. And she knows that's going to attract a whole ton of lawsuits. So there is stronger indemnification language. But the one thing that Skydance has been against, and it's been a non-starter for David Ellison, is that Shari Redstone had been kind of pressing for this majority of the minority kind of approval, which was basically all of the Class A shareholders getting a say in whether the deal should be approved or not. And it looks like that has finally gone away. So that's no longer a sticking point.
Geetha, John keeps kind of making fun of me because I'm not that particularly interested in all of the ins and outs of this roller coaster that we've been seeing, or this pin turning kind of road. I just want to understand, is this billionaire poker, or is there a deeper kind of broader takeaway from this?
I mean, the sands are really shifting. I mean, the winds have been shifting in the media landscape here. It's obviously clear, Lisa, that the more and the more that this process drags on. I mean, we've been seeing this thing now play out for over 6-7 months. The more that it drags on, obviously, the less the assets are going to be worth. And I think Shari Redstone realizes that. She knows that something has to get done. At the same time, we know that this is maybe one of the last big iconic assets. I mean, you have a huge film studio. You have some great broadcast network assets as well as stations and CBS. There is, a streaming business, again, that the jury is out whether that's a good or a bad business. There is the linear network business, which is what is weighing the whole model down. But again, it would be an understatement to say that assets like these are not going to come around often. So obviously everybody wants to throw their ring in the hat.
Geetha, you make it interesting, okay? Geetha Ranganathan of Bloomberg Intelligence. Geetha, thank you. The latest on Paramount, that saga continues, and I guess it ain't over till it's over, but I think a few of us are hoping it might be over quite soon. Coming up very shortly, we'll get some jobless claims data for you, and we'll get the views of Thomas Simons of Jefferies and Mark McCormick of TD Bank to get some reaction to that. And Lisa, push ahead to what we'll hear a little bit later. You've been looking forward to the ISM services. I have as well, particularly the employment component of that, to get a feel for what we may or may not hear on Friday.
This has been the pillar of support for the U.S. economy. We've seen manufacturing turn a little bit lower. The revival there hasn't taken off. If you see services weaken, that will be a real red flag. We've heard that from the ECB because they have a similar kind of situation with respect to services and inflation there. In the U.S., that really is what a lot of people are focused on.
You think if we get a big weakening over the next couple of weeks, it opens the door to a July cut, or do they need to sort of lay this up, tee this up perfectly so they can go in September after a big Jackson Hole speech that sort of takes us towards this mid-cycle adjustment?
I don't know. I don't know how high the bar is to really talk about July once again. I do know that there is this feeling that we're reaching a tipping point. Mary Daly has been ahead of the game when she's talking about that. And we definitely heard a slightly different tone from Jay Powell yesterday. So I honestly don't know the answer at a time when people are still expecting pretty strong readings, particularly in the services and particularly when it comes to travel.
Powell testimony next week. One to watch. So, if you want more from Chairman Powell after the payrolls report, you'll hear from Chairman Powell after the payrolls report. You'll hear from him for hours in Washington.
I wonder if they ask any real questions about what tariffs do to their outlook. I mean, he's going to say, we don't get involved, we'll deal with the thing that we have to deal with, et cetera, et cetera. But Goldman Sachs coming out with that call.
That's quite cool, isn't it?
5 rate hikes. That is what it's equivalent to in terms of the inflationary read.
Yeah, it's pretty amazing. You know, I often get excited about these testimonies, and then what happens? It's like, you know, people making YouTube clips for their own campaigns in November.
Yeah. What do you think of Twinkies?
Yes, something like that. From New York, this is Bloomberg. Jobless claims about 20 seconds away. The score's going into it. Equity futures look a little something like this on the S&P 500, negative by 0.1%. On the Nasdaq, a similar move. Just moments ago, we got the ADP report. That came in at 150. The estimate was 165. Another taste of the labour market coming right up. After this, we'll get the ISM a little bit later. Then it's on to payrolls on Friday. With the jobless claims number, let's get back over to Mike McKee. Morning, Mike.
Good morning, John. Very little change in jobless claims. 238,000 last week, 1,858,000 in terms of continuing claims. So that's a little bit higher than it was, but we'll see when we get the revisions numbers out in just a second, waiting on those. But it doesn't look like there's a whole lot of change at this point in the status of the labor market. At least not in terms of claims. 238,000 last week, revised up to 234 from 233. So it's a gain of 4,000, and continuing claims were revised to 1,832,000. So we are up by about 25,000 on continuing claims. So it does look like a little bit of deterioration continues in the jobless claims area, but still very, very low.
Just creeping a little bit higher, Lisa. We didn't see that deterioration in jolts yesterday at all, moving in a positive direction, but you see just a little bit of it there, just a little crack.
Honestly, I just pulled up a chart of continuing claims over the past year. You could just see a marked increase over the past 4 weeks. That's the kind of action that people are going to hone in on, is saying possibly you are seeing some sort of pivot point, inflection point in the labor market.
Mike, what do you make of that, what that chart looks like?
It is maybe a pivot point, but it's the kind of thing we're not going to know for some time, because we're going to have to see, with jobless claims, they come out every week. So we're going to have to see if this continues or if it's a short-term thing. Now, we're getting into July. That's usually when the automakers shut down their plants for retooling, and we lose some workers to jobless claims on a regular basis. So that'll be a seasonal adjustment question coming up. So it's going to be kind of hard to tell from claims if we've reached that inflection point or not. That's why the Fed's going to be more interested in what's happening with the unemployment numbers than the claims numbers. Claims will give you a hint, but it doesn't really give you a definitive answer to where we are.
It does give you a hint, though, that things are changing, and they are changing in a sort of linear way, at least when you take a look at continuing claims, at least over the past couple of months. You do wonder if the Fed's going to try to get ahead of this. Claudia saw him yesterday talking about how once they wait until they see the whites of the eyes of a cracked labor market, it is too late. Do you hear any sense of that among Fed officials, as we've heard a number of them speak over the past couple of days?
I don't think we've seen that yet. We're seeing people making the argument that, yes, we have to be aware of this, because they've been pushing on the idea that they're looking more at the employment part of their mandate than they were during the last year, when they really focused on inflation. But nobody has suggested yet that they're close to the edge. The general feeling is we're still seeing a strong enough economy that we can wait. Now, what does wait mean? That's going to be the thing to look for perhaps next Tuesday from Jay Powell. Does it mean that they have till the end of the year? They think it's going to be that strong, or are they on alert for any kind of change that comes very quickly? We might mention the SOM rule coming up on Friday. If we should see that trigger, then the markets are really going to react and argue that the Fed needs to hurry up or they're going to be behind.
I'm sure some super dialed-in lawmaker in Washington, D.C. will ask the question, Mike, in that testimony next week. Mike McKee, thank you.
Really?
Have you got doubts?
Really?
Is that what you think of our lawmakers in America?
You always like to... I love this. You like to put this on me. He just basically projects out. He's like, oh, Lisa is really undermining the U.S.-American legal system.
I've got way more faith in them than their teams to come up with better questions. Their staff, yeah, exactly. Let's bring in the team. Thomas Simons at Jefferies, Mark McCormick at TD Bank with us around the table. Thomas, let's start with you. Won't talk about that. Don't worry about that.
Okay,
let's talk about jobless claims. What do you think is sort of normal and what's worthy of worry as we start to creep a little bit higher?
So normal is really hard to define, right? I mean, we've had many different states of normal in the last 4 years, and I think that on an almost daily basis, there's a new sort of remark of where normal is, right? Last few months, it seems like 230K was more or less normal, 220, something like that. I think that that's probably a decent enough benchmark for the next few weeks at least. But as you get into the end of the year, we'll probably continue to creep a little bit higher, right? If you go from 230 to 250 or 260 over the course of 6 months, that's actually exactly what the Fed wants, right? Like the whole thing with like the SOM rule and these inflection points and whatnot is that this concept that economic data, goes down on an elevator and up on an escalator, right? Like there's momentum that becomes self-reinforcing. If we in fact actually get this very gradual decline in labor market pressure, I think that's actually quite a good outcome.
Okay, let's build on that a little bit more, because Citi were with us earlier and they said 260 is the danger zone for jobless claims. They've got a different view on this. They just don't think that you stabilise at this lower level. You don't plateau here, that once this journey starts, it continues.
Right. And I mean, you look at 85 plus years of labor market data and it supports that fact, right? That when things start to go wrong, they get wronger and wronger, right? But the issue is, I think we have a very different set of demographics that, is not consistent with any other real, labor market episode we've had in the economy before, right? We have a shrinking prime age labor force as a percentage of the overall population. We're 10 plus years into baby boomers retiring at a rate of about 10,000 people per day. We still have about 6 more years of that to go. So the labor market shortage, the scarcity became extremely acute after the pandemic was over, but that's not a temporary factor. That's actually a secular trend that's going to continue for years.
Mark, is it different this time?
I think what's important is really kind of considering the supply side of the economy as well, along with the growth side. Like everyone is very focused on growth for the Fed, but it's like we kind of dropped the ball that inflation is still kind of the key metric. And it's like what we do is we run strategies and we're trying to figure out which themes are driving the markets. Like everyone's talking about this, but this factor is what makes money, and no one's talking about that anymore because it's not as interesting. But a key thing is if you look at currencies, they are trading more on inflation than growth. And if you run back tests on data surprises, consensus revisions, data strength, those things aren't working. So while it's interesting to kind of work through the data and say this is important, this is what's driving the Fed, at the end of the day, what's going to drive the Fed in the next 3 months to September is inflation. So if inflation's hot next week, or if it's hot in the next month, or if it's one hot inflation report could kill the entire narrative that they will cut this year. So I think that's one of the important things to think about is what we tend to do from a market strategy point is kind of aggregate all the data, scale it, compare it to different countries, and which country looks better. Right now, it's still very clear that U.S. is slowing, but it's slowing from a very hot level, but it's still good, and it's still better than most of the rest of the world. So I still think that's a key consideration that while we could move into this inflection point where we go from linear to nonlinear, and that's kind of how complex systems work, but if it is a linear slowdown, you're just moving in a direction that markets are already prepared for and absolutely priced for this year.
So you don't think that there's a point at which the labor market becomes a check on the ultimate read that you say is inflation?
If it's nonlinear, yes. But I think the thing on the inflation side is the drivers are coming from the supply side. Demographics, geopolitics, the changing nature of technology, the pricing around those technologies. I think when you think about war and some of the things that we've had on the energy side, all the things that are happening on the supply side have been accelerating through the pandemic, but these are things that started in 2010. If we kind of look at all the, if we look at like what is happening with globalization and what is happening and how that impacts national sovereignty and politics, those things are all moving in a direction. Even if you think about immigration trends, all these things are potential drags on the supply side that makes inflation stickier over time, which has nothing to do with demand or growth. So I think those are things that are happening behind the background that the Fed has no control over that they have to be cognizant of. And also in the next couple of months, we're going to see base effects also just push inflation higher just naturally from, the math of things moving around. So those are considerations. I know the market is really focused on the growth story, but we're still really focused on the inflation side for the dollar, for the market, and for the Fed.
Tom, do you agree?
Yeah, more or less. I mean, I think that our views on the supply side are very similar. I've kind of been trying to, and again, sort of assessing new normal, like looking at what consumption patterns are looking at, like, and kind of understanding this dichotomy of, haves versus have-nots in the economy. I think that there's probably some dynamic where, we focus all this consumption pattern recognition on, people traveling, entertainment, all these things that are really, services that are enjoyed by higher income households, right? A lot of that happens in the second half of the year, right? So like while we've seen growth slow down, we could just have all of that activity kind of concentrate in the second half, and then we'll see the kind of logjam of supply not really being able to meet demand in certain sectors, right? I think that in the service sector, that's going to be something that we see consistently over time, again, for many, many years. Certainly you see it in the housing sector. I mean, like that's probably the best example. I think that a lot of folks who've been more sanguine on inflation have been expecting that we're going to get some delivered disinflation from rent and the OER and whatnot. We may get that for a short period of time, but at the end of the day, we're still very undersupplied with shelter, and I don't think that you can consistently expect that that's going to be something that's relatively soft over time.
Let's complicate things, and I mean really complicate things. Jan Hatzius of Goldman, with this to say in Sintra, Portugal, I imagine this will get picked up everywhere. On Wall Street, in political circles, maybe much more so. This is what he had to say. The Trump proposals coming from the Donald Trump campaign could raise the average US tariff rate by 16 percentage points to nearly 20%, which would be the highest in the post-war period. So that's sort of what their base case is. And this is what they think the implications are for monetary policy. Hawkish to the tune of 130 basis points because the large hawkish inflation effect clearly outweighs the smaller dovish growth effect. At Goldman, Jan Hatzius is sort of modelling out the potential for something like 5 hikes from the Fed based on policy from the Trump admin. What's your reaction to that?
So my view has been that if the Fed were to have to hike again, they would have to hike something like 5 or 6 more times. Like one more hike wouldn't really do too much, right? If we're pricing in one hike, we should price in substantially more. I don't necessarily share the view that tariffs should be, should generate that sort of reaction. I remember even in 2016, 2017, when Trump was initially putting on his big tariffs against China, Yellen's reaction was like, hey, look, tariffs increase a price level once, but they don't create like an upward slope of prices, right? So it may be needed to kind of, maybe offset one vector of inflation, but I would be very surprised if Trump actually did imply, put in policy a tariff that was that high. And I would be equally surprised if a Chair Powell would react that way.
Well, there's a lot of scenario analysis taking place right now. Mark, work with us. Let's say that is the assumption. And let's say those policies are delivered. Do you think that would be the reaction?
Well, yeah, that's a very spicy proposal. I think part of it is that it's, again, two-sided. Like you have lots of inflation, and the other thing is you are taking away growth. So we are in Goldilocks right now. Our macro vol models are basically at the lowest levels we've seen through this cycle. Carry trade's kind of incrementally blowing up here or there, but carry does struggle when you start to see volatility. But a big piece of that is if you have like essentially growth being taken away from China and Europe and even parts of the US, and then you have higher inflation, you have the Fed responding to that. The initial move is a much stronger dollar. It is a complete decimation of Goldilocks and a move into a higher vol environment. So I think the markets are not prepared for this at all. And I think that's, again, you come back to like what happened in the debate, and then you kind of look at, we had the French elections over the weekend, which were important, but as soon as we got the Supreme Court ruling kind of coming out on Bloomberg, dollar rallies. So we are like right back into the kind of silly season here where every headline related to a poll or who's happening, is Trump leading, all these things are going to drive markets now, at least, if not through the summer, September, it's on. So if we move into that direction, just the thought or the uncertainty of the Fed having to reverse course and actually start hiking again will be very bad for risk markets.
Either way, Tom, and this is something that we keep talking about, what does this mean in terms of what the neutral rate could potentially be? Not just rate hikes, but just how far the Fed can cut. We were talking to Sonal Desai. She's talking about 4 to 4.25%. So even as we talk about the idea of a labor market that's normalizing, there is a floor to how far they can go. Do you agree with that?
I do, actually. It's more or less right around where I think the terminal rate is going to end up, probably sometime towards the end of 2026. I think that it's something the Fed really needs to be very careful about. We see more research coming out, for instance, from John Williams at the New York Fed, just put out another paper this morning saying that, he still doesn't think that R-star has moved very much. I have to give some deference to him. He's spent probably more time than I've been alive studying this, so I can't really, say that I know more than him. But I
just aged him a lot, though.
Well, I de-age myself, I think. I like to focus on me a little bit more. So
Are you a bond trader?
Yeah. I don't think that it's that easy to dismiss that we're in the old normal. That R-star is still around 2.5%. It wasn't that long ago that the Fed still thought it was quite a bit higher. So. I think that if we do get, for instance, another wave of tariffs, it really lowers potential growth. And then I would be willing to entertain the fact that perhaps we are moving to a lower rate environment overall, because it's functionally like a tax, right? Like, as much as it's tariffs are on the exporting countries, at the end of the day, it's paid by the consumer, and it's just a deadweight loss for them, right? So they'll have to take that consumption out of something else that just lowers the sort of dynamism of the economy, and I would think probably lowers the potential interest rates.
Mark, given all of this, why would anyone short the dollar? Why wouldn't everybody be as long as the dollar as they possibly could right now?
That's my view. I would agree. It's you have, just on the factors that we run, the dollar is ranked number one in our trading baskets on growth, on risk correlations, on inflation, and carry. And so in this environment, the one thing, if you look at correlations of the dollar to risk models, pre-COVID, it wobbled. Sometimes it was cyclical, sometimes it was a safe haven, kind of moved around. Since the pandemic, that correlation has not gone below zero. So essentially when we're risk off, the dollar is the only safe haven. The yen is no longer a safe haven. Swiss franc's no longer a safe haven. They are cyclical currencies. So I think in this environment, especially if we are focused on inflation or if we are focused on growth, the other interesting thing is the only other places that offered yield are the places where everyone's been positioned in FX for 2 years. So you bought the commodity terms of trade story, you bought the emerging markets that were the sellers of those. They were also the ones that offered the carry, but Latin America is no longer kind of immune from all of this. So I would say, the other thing is the dollar represents at least 62% more yield pickup than all the currencies that we track. So to me, this is I wouldn't say a no-brainer, because that's, that's the last thing you should say. But I don't see the upside for the euro or G10 currencies in the second half of the year. But I feel like this is broad dollar. It's not RV markets anymore. You should just be long the dollar into the second half of the year.
Mark McCormick at TD. Mark, good to see you alongside Thomas Simons of Jefferies. If you are just joining us in the last 30 minutes or so, we've had some economic data. 150 on the ADP employment report. 150,000 was the number. The estimate was 165 in our survey. Had some claims data, continuing claims creeping higher once again. Claims 238k. The estimate was 235. Payrolls, of course, coming on Friday. The ISM in about an hour and 15 minutes. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get across to Danny Berger. Hey, Danny.
John, you stole my line. I was going to go over the jobless data. I'll do it again in case you missed John do it. Initial jobless claims coming in at 238,000. That is a touch higher than the estimate of 235,000. Continuing claims rose for a ninth straight week, the longest stretch since 2018, and an indication that a growing number of people are having difficulty finding a new job. Earlier, as John mentioned, we had the ADP report. Private payrolls increased 150,000 last month. The median estimate in Bloomberg survey called for an increase in 165,000. JP Morgan's chief market strategist, Marko Kolanovic, is leaving the firm to explore other opportunities. And according to an internal memo obtained by Bloomberg, he's a 19-year veteran at the bank. Kolanovic and the team at JP Morgan had a rough few years trying to call this market. He was bullish for much of 2022's slump and turned bearish as the market bottomed. At 4,200, he still has the lowest S&P 500 price target among analysts, as the S&P hit 32 record highs this year. Donald Trump's sentencing in his New York hush money case has been delayed by 2 months to September 18th. This is so judges can review the impact of that landmark U.S. Supreme Court ruling about presidential immunity. The sentencing would come less than 7 weeks before the likely Republican nominee's rematch against President Biden on November 5th. Trump faces up to 4 years in prison for the criminal case. And that's your brief, John.
Of course, it sounded much better when you did it. Danny, I'm sorry about that. Sorry about that. Up next on the programme, setting you up for the day ahead, you're watching Bloomberg Surveillance. What do you do on mornings like this? Do you wait for the ISM or do you get in the car and head to the beach right now? How does it work?
You obviously wait for the ISM.
Of course you
need
do.
to.
Yeah,
That is what I'll be waiting for.
You stay in the city all week until payrolls drops at 8:30. That's what you do.
And even on Friday.
Yeah, sure, same. Counting down to the opening bell. Here's the trading diary for the rest of the week. ISM services data coming up at 10 a.m. Eastern time. Then the FDR is going to be jammed coming out of New York and getting over to Long Island. It's going to be so busy, isn't it, after 10 a.m.?
Yeah, no, that's true. That's why.
Fed minutes, 2 p.m. People might hang out for that. Equity market closes at 1 p.m. Remember, bond market closes an hour later.
You can't even keep a straight face with that one.
Payrolls on Friday. Plus, of course, tomorrow, look out for the team in London carrying our coverage of the UK election. On Friday, just a programming note, Lisa and I won't be here. We would love to be here, but we won't be here. Danny and Manus will be doing the coverage for you on Payrolls Friday.
We begged to be here, and they said no.
I actually really asked, and they didn't want me here.
Yeah,
so
they were
there you
like,
go.
please.
Just stay away. Let's turn to geopolitics. Anne-Marie sat down earlier for an exclusive conversation with Ukrainian President Volodymyr Zelenskiy. She joins us now for more. From Kyiv, Anne-Marie, good morning.
Good morning, John. Russia's invasion of Ukraine is in its third year. They're entering their third summer, and yet top of mind for Volodymyr Zelensky seems to be what we all watched, the U.S. presidential debate and where U.S. politics are going. And I got the sense that Volodymyr Zelensky does not want to take any chances with the outcome in November, and he wants to get in a room with former President Trump. Take a listen.
I'm potentially ready to meet with President Trump. Of course, for me, it's very important. So for me, it's very important not to have any surprises, which can be very tragic to Ukraine. I mean, that I don't want to have any surprise. I want to understand what he means. They can't plan my life and life of our people and our children, etc. That's why I'm not pushing to. I'm just, my message is if they have the plan, it can be maybe not public because of the elections, but I think we have to know it before to prepare.
So Zelensky is challenging Trump to come forward with his plan. I got the sense from him he doesn't want to do back channels. He doesn't want to do anything that's illegal or illegitimate because the former president is just a candidate right now and he's not running policy. But clearly he wants to make sure that Ukraine is set up to potentially work with the Trump administration, because we heard Donald Trump at the debate that Zelensky watched when he talked about he's going to have the conflict solved before he even gets into office. And Zelensky wants to hear that plan. There's lots of rumors about what it is, about potentially if Kyiv does not want to negotiate, then former President Trump would withdraw some of that aid. And if Moscow doesn't want to negotiate, then he's going to ramp up the aid to Kyiv. But Zelensky, it sounds like he's signaling he wants the conversation.
Hey, mate, just before you go, you've been in the country for a number of days, in the city, in Kyiv, in the capital, for a number of days as well. Just describe what that's been like this week.
Well, right now, Ukraine has changed some of the mobilization, so you are seeing an uptick of the draft of more younger men out to dinner. A waiter actually apologized for how slow they were because it is affecting their economy already. But the issue they have on the battle lines is not so much the weapons right now. When you talk to military analysts, it's the manpower. So you can see that still in the city. Also, they've been living this for more than 2.5 years, but I've been quite new to it. Every single evening, almost, you're woken up, you have to get out of bed, and you have to go into a bomb shelter. This happens at night. This happens at your desk while you're working. So this is still a society that is living with this paranoia and anxiety on a constant basis.
Heartbreaking. Thanks for sharing the experience, Anne-Marie. And once again, fantastic work. Anne-Marie Hordern in conversation with the Ukrainian leader. Lisa, incredibly savvy political media operator, to turn to the camera and speak in English at a time when he felt like he really needed to.
Basically saying, I don't want to have to rely on somebody else to determine my future. I want to be able to prepare in advance. Taking a step out, an incredibly timely interview by Anne-Marie, given the fact that, as you pointed out, it's not just how the debate reads across America. It is how this debate and how the broader election race in the United States affects the entire world. We have heard the ramifications from leader after leader, very much front and focus for Volodymyr Zelensky, who frankly has really been on the receiving receiving end of both the delays as well as potentially the aid to continue this war?
A lot changed for a lot of people, and maybe even many countries after the debate on Thursday night. On Friday, looking ahead to Payrolls Friday, here's the lineup for you. Peter Oppenheimer of Goldman Sachs, Sarah House of Wells Fargo, Priya Misra of JP Morgan, Jeff Rosenberg of BlackRock. A stacked Payrolls Friday lineup for you. Danny and Manis are going to run you through that. The estimate for Friday, 190,000 from Lisa and myself. That does it for us. Have a wonderful long weekend. For those of you that can celebrate a long weekend. For the rest of you, particularly stateside, have a very blessed 4th of July. From New York, this was Bloomberg Surveillance.